Good afternoon to all of you. A very warm welcome to Bitkom's first Digital Euro Summit. My name is Bernhard Rohleder. I'm CEO of Bitkom, and I just give you a short introduction into the issues of our today's conference. What is the background and what are the topics of that conference? First of all, it's digital transformation, sovereignty, and digital innovation, from cash to card to contactless, to mobile payments, from the physical wallet to the digital wallet. That's what we will be talking about. Digital transformation of financial services becomes visible every time we pay. Me personally, I do about 90% of all my payments with my smart card, the smart watch, and I have no more money belt indeed. Globally, payments have become a core strategic pillar of the finance industry and are therefore critically important when talking about Europe's sovereignty, linked to the question how to maintain competitiveness against players from the US and Asia. Technological progress in the field of blockchain, DLT, and CBDC fuel this competition. For instance, China plans to roll out the digital yuan already in 2022 for the Olympic Winter Games. Second issue is Libra, DM, and CBDC. Libra, now DM gave us a wake-up call and is now the key driver for bringing international policy stakeholders from administrations and central banks to the table to discuss the idea of CBDC. And this summer, the ECB declared to launch the project Digital Euro, which is maybe the most important step for Europe, or at least for the financial system of Europe, after introducing the euro as a common currency. Now it's time to gain some ground against other regions to ensure a strong euro adapted to the needs of the 21st century's digital economy. Our third issue is blockchain, our crypto assets, and is decentralized finance. When we talk about innovation in payments, we also have to talk about blockchain DLT solutions, as well as crypto assets and the potential of decentralized finance. Those disruptive developments are transforming our financial ecosystem, enabling new business models and changing existing ones. Some cryptocurrencies, e.g. Coinbase, are already worth more than some of the largest legacy banks in Europe. We cannot afford to further ignore this trend, and my feeling is that both the political and regulatory world, as well as the financial industry, would agree with me on that. So what role will cryptocurrencies and the blockchain technology play, and how do they relate to central bank digital currencies? Those and more questions around central bank digital currencies, stable coins, and crypto assets will be addressed in the next 4 hours, filled with some of the key global stakeholders shaping that space. For instance, Jörg Kukies, State Secretary of the German Ministry of Finance, Joseph Labin from Ethereum, Christian Catalini from the DM Association, Sheila Warren from the WEF, or Ralf Wintergerst, who is CEO of Giesecke and Devrient. The future, ladies and gentlemen, the future of money is now. There's absolutely no doubt about that. I wish all of us an interesting afternoon and head over to Kevin Hackel and Patrick Hansen, who will guide us through the first Digital Euro Summit. Thank you very much for your attention.
Thank you very much, Bernhard, and hello and welcome everyone also from my side to the first ever Bitkom Digital Euro Summit 2021. We are excited to kick off the next 4 hours that will be packed with keynotes, packed with panel discussions on the future of money and the future of finance. My name is Patrick Hansen. I'm head of blockchain at Bitkom, and I have the great honor of co-moderating and co-hosting today's summit alongside my friend and colleague Kevin Hackel, who's in charge of digital banking and digital payments at Bitkom. So today's goal is really to shed some light into some of the biggest buzzwords in the industry: central bank digital currencies, CBDCs, stablecoins, cryptocurrencies, and decentralized finance. And to that end, I'm really honored that we have gathered some of the key stakeholders in those fields. We will have guests from banks and central banks, from crypto companies, from corporate finance, and also from academia and political institutions. So I'm personally really looking forward to the next 4 hours.
Thank you, Patrick, for again welcoming our attendees today at home, unfortunately, which is still due to the COVID pandemic. But still, before we kick off, there is one thing we'd really like to ask you to do, which is be part of our Today Digital Euro Summit. Now, you may ask, how can I do that? Well, that's quite simple. I invite you, as you're following our live stream, use the chat function. Let us know your questions. Let us know about your concerns. Let us know what you're interested in. And Patrick and I, we will try to give our best to provide some room for those questions when discussing with our experts. Furthermore, and you can also see this hashtag on your live stream, DES21, which of course stands for the Digital Euro Summit. Let everyone in your social network know that you are part of this, because as Patrick already pointed out, our goal is to educate as many people about CBDC, stablecoins, crypto assets, and of course, the digital euro. So, if we can now, if we think what we can do next, I think one important thing is to first point out, how do really banks approach a project called the digital euro? What does the digital euro mean? What does it mean for the ecosystem? Will it change the way how we pay? And I think probably there is no better guest that is better prepared for providing his inside view to gain some insight into the machine room of one of the global largest banks, which is Deutsche Bank. And I'm very pleased to now welcome Stefan Hobbs to the stage, who is head of the corporate bank of Deutsche Bank. And first of all, let me express my gratitude for getting up early today, because you're not streaming from Frankfurt as you would normally do, but you're streaming from New York. So thanks for carving out some time and to share some insights with us, but also with our audience. Stefan, the stage is yours. We hope you're doing fine.
Perfect. I hope so too. Well, thank you for the invite. And a warm welcome to the Digital Euro Summit from my side. Now, is the digital euro threat or opportunity for banks? Well, that is a ridiculously self-centered, a self-loving question for a bank to ask. And I think if that's how we approach it, then my grandchildren will definitely read about us in history books. So the right questions that we should be asking is, who actually needs, who will use the digital euro? And what will it be used for? And how will it be used? And I think if we spend time in trying to answer those questions, then we can actually earn the right to try to answer what our role, like what our value add as banks will be in that ecosystem. Now, if you take a step back and think about what we banks actually do, we cater to a variety of client types. So that is retail consumers, banks, institutional clients, corporates, the government. And we cater to them through a variety of channels. So that can be a branch, that can be electronic, that can be contextual, which is more and more used. And we provide a variety of services, of functions, stuff that we actually do for the ecosystem. Now, when we look at those functions, you actually see the interplay between us banks and the central banks. And we do three pretty basic things. So we store value, we transfer value, and we allow value to time travel. Now, we have fancy terms for that, right? So when you think about the storage of value, that would be called a deposit. And obviously, central banks have cash. If you want to transfer value, so you want to transfer euro into another currency, or you want to transfer euro into something that you buy online or in a store, then we do a digital payment. And the central banks would do a cash payment. So that would be the transfer of value. If we do the time travel element, which obviously we call a loan, we allow you to consume today and repay tomorrow. And again, that's a pretty important function that us banks do, because we actually allow you to buy a house today, take on a mortgage, and then you promise to continue working hard and then repay over time. Now, central banks do not have that sort of loan because they are really focused on cash in the current context. if we ask the question of what that will look like in the future, so what, going through the various client types and the various channels, how will storage of value, transfer value, the lending aspect of it, what will it look like in a digital euro, in a digital current environment? I believe we still have an important role to play because people will still want to store value because they have worked hard, they have made money, and they want to store that value for the future. So I think that you will have tokenized deposits that will probably be insured similar to today in the future. Now, on the central bank side, we will have CBDC, probably focused on retail, maybe focused on corporates at some point, but that's essentially the storage of value element. When you look at the transfer of value, I think that the future will have wonderfully many opportunities for us to transfer value. It will be much more programmable. You may have machine-to-machine payments. As a father to 3 children, the idea that I could program the pocket money so that it cannot be used for candy or other things that as a parent I wouldn't want them to buy, who knows what the future will bring. But again, it will be the transfer of value from from money into something different. I think what's going to be important for central banks to develop is offline payment functionalities for the CBDC. Because unless we have that, it's not going to be similar to cash, which by definition is also offline. When you think about what lending, so that time travel, you can consume today, pay me back tomorrow, what that will look like in the future, it may be called different things. It may be called buy now, pay later. It will be much more contextual. But again, the idea of providing credit to the real economy, to corporates, to states, to consumers, that is something that will be needed forever. So the point I'm trying to make is, if we continue to be nimble and humble, and we avoid buzzwords, and we look at actual use cases, which could be machine to machine, then us banks will continue to have a role to play. Now, if we only approach it by saying, well, is this thing, the digital euro, an opportunity or threat? Again, that would be incredibly self-centered, self-loving, and would not help. Now, I'm really looking forward to the variety of sessions we have throughout the day, because there's plenty of homework that us as the various players in the financial ecosystem have to address and have to work through. And if I can, as the first speaker, give my fellow speakers some things to discuss, really for regulators, central banks, banks, but obviously also corporates and other participants in that ecosystem, it would be the following. I think for banks, we have to properly develop tokenized assets. It's going to be important that they will be interoperable. Right? If we have tokenized deposits for Deutsche Bank, they need to be interoperable with Commerzbank and savings banks and banks in other countries, because otherwise it wouldn't be the same sort of use case that we have today. We also have to work with our clients, with corporates, with institutional clients, to actually find real-world use cases, right? Trigger solutions, whatever it may be. But we need to actually find the real-world application for the blockchain technology. When you look at regulators, and I want to be very humble in imposing homework on the regulators, but we need to have clarity, right? And I think the BaFin's crypto custody regulation is a really important step in the right direction. Secondly, I think it's going to be important that we will not have domestic solo initiatives. What we need as Europeans is scale. And if every country kind of has their own initiative, their own regulation, that's just not going to give us a scale to compete with the United States, with other big big players. So therefore, please harmonize, please team up. When you look at the central banks, and again, I want to be humble in imposing homework on the central banks, but we need to have clarity on the design dimensions and actual use cases for the digital euro. So will the CBDC just be focused on retail? Will we have a wholesale CBDC? I think we need to have clarity in that. And at the same time, we need to have a very active dialogue to understand what the various participants in the financial industry, what role they will play going forward. So what is the role that us as banks will provide? I mean, again, in the current environment, sort of 90% of what is considered to be money is deposits, is essentially private bank money. And it's going to be interesting to decide, discuss, debate, figure out what that interplay will look like in the future. Now, for corporates and other market participants, I think it's going to be important to just try stuff out, right? To just look at for your respective business, what are the use cases? What, if you look at the value chain, what can you actually start doing on the blockchain? Because I think one thing is clear: the actual challenges and the true potential of this new technology, we will only find out if we actually start to experiment and actually look at real world use cases. That was it from my side. Would love to take some questions and have a discussion. Hopefully the key points came across, that us banks will try to approach it as humbly and nimbly and avoiding buzzwords as possible. And we're really open to discussions with fintechs, obviously with our clients, with the regulators, with central banks. It's going to be a huge change for many, many use cases. However, again, I think the basic functionalities of preserving, storing value, transferring value, and allowing value to time travel, that will always be the case. So I'm hopeful that us banks will have an active role to play. Thank you.
Thank you very much for sharing your thoughts. I think you did a great job, because you basically outlined what's going to happen next hour, because we're going to talk about drivers, use cases, but also about design functions. Maybe one question. I think you did a great job, in also relating to what money means, what roles, what function it does incorporate. And you raised a lot of interesting topics. I would like to dig a bit deeper. For instance, you mentioned machine-to-machine payments in the future. Programmable Euro, I really like the example with your daughters, I think it was. That you're a bit in charge of what the pocket money, or where the pocket money goes to. Maybe you can give us an idea about what you think, how payments with the help of CBDC Digital Euro will develop, what we may not be aware of as of now, and maybe to link this to a question we have from our audience, where it was asked, what actually can central bank digital currencies do that digital currencies we have as per day, electronic money, can't. So I think this is an important distinction, especially for us as consumers. Where's the difference for consumers and you as a bank, maybe?
Really good question. So we'll obviously actively work with the ECB, with central banks across the globe to develop CBDCs. But at the same time, I think we need tokenized deposits much earlier. I think it's going to be important if we want to properly use the Internet of Things, where in many cases machines will communicate, right? And my car will send a signal to my fridge and will check whether I still have milk, and if not, it will order milk and so on. And I think if we want all of this to actually work, we will need to enable machine-to-machine payments, which will be difficult in the current ecosystem. So therefore, if we just look at that use case, I think especially for Europe, given the relevance of us as manufacturer of many of those like hard assets that will be connected in the future, I think we just need to support the real economy and the manufacturers by developing digital euro use cases. And again, I think that will not be CBDC, because I think my understanding is that it will be a retail CBDC first and will take a few years. But I think the digital euro, the tokenized version of current money system, that is something which we need much earlier. To give all of us comfort, I think that corporates are pretty well advanced in understanding the use cases. So I think the good news is that we actually have pretty specific requests and descriptions of the challenges that we have to solve or help solve. But again, a lot of work ahead of us. And I think when it comes to the homework questions or items that we pose, especially the clarity from a regulatory side, plus the interoperability term that's always very difficult for me to pronounce, but between the tokenized asset deposits of various banks, I think those are the most immediate challenges that we have to solve.
Thanks, Stefan. And I think not hard to pronounce, but also hard to establish interoperability. And you also before talked about harmonization, which I think is great. I mean, we've seen Germany, for instance, also pioneering in this field, and I think now it's important to get us going at least as Europe and to have a strong euro. Maybe I want to get back to another thing you mentioned. You said you are working with central banks, but you are also working with fintechs, and it became clear still in our today's discussion we have a lot of ideas, but not too many ideas on the concrete side. So actually, what's becoming implemented. How do you see, I don't know, fast forwarding 5 years? I mean, that's the tricky question always, but how would you assess how the field of competition may change in the future for you as a bank, or will we even grow together even more as an ecosystem? How would you assess the future of payments?
Really good question. So I think that we have, so if we agree that we have 3 categories, clients, channels, and products, right? And again, I think that we will have, that we had 100 years ago, then the channel was branch, and we will have in 100 years, in that case, the channel will be contextual. I think that fintechs are incredibly strong when it comes to channels. Right? I think that fintechs are really, really good in figuring out how different types of clients want to consume financial products, and they make it incredibly convenient. And there's a lot to learn for us as banks from fintechs, because they're so use case convenience focused, which, to be honest, it's not that we forgot, but we probably didn't focus on enough. I think when it comes to the products, I think even in the current environment, they're typically done by banks. So typically, if you store value, if you take a loan, if you have the buy now, pay later, you typically, if you actually see through the whole value chain at the end, you will typically have a bank providing all of that. So I think even in the current environment, I think the interaction is much, much closer than people imagine. Right? We're not competing in many cases. We sort of enable each other. And I think that will continue to be needed in the future.
Very good point, and we are very happy to hear that. As you know, being member of Bitkom, we're the financial home or the political home to banks, but also the fintechs. So I think this is. I'm really happy that you pointed out this approach. Maybe as we're running out of time, and as fun it would be to go on. You've mentioned a few homework tasks in a very humble way. Maybe looking for the major challenges ahead, what do you think is the #1 thing that needs to be resolved rather fast than slow?
Willingness to experiment. Sounds super easy, it's so difficult. I think the willingness to be humble and tell clients, look, I need to understand what you actually expect me to do, and then try things out. And especially at a large bank, the interaction with the various control functions, experts in technology and operations, just being willing to experiment and potentially fail. I think that is the most immediate challenge. And again, I will only know the true potential or actual challenges once we try it out.
Stefan, I think this is just great for all of us. Just stay curious and try to figure out things by doing it. Stefan, I and the entire event team here on premise, we wish you a great stay in New York. Thanks for joining us, for tuning in, and hope to catch up on this issue anytime soon.
Perfect. Really looking forward to a wonderful Digital Euro Summit. Thank you very much.
Thank you, Stefan. All right, I think this was quite a nice introduction. We touched upon several aspects. I heard keywords such as design. We also talked about some use cases, which indeed will be the center of attention of our first panel, which I think is great because the panel always helps us to get the discussion going. So what we are going to do in the next somewhat 40 minutes is to pose the question, why do we actually need a digital euro? Or what do we need it for? And what are the drivers behind a digital euro? And also what use cases do we see? So because innovation is nice, but if innovation doesn't get adapted, it's pretty much worth nothing. So on that note, I'm very happy to welcome a quite diverse panel now in my round. I'm happy to have here from the ECB, Jürgen Scharf. We also welcome in our round Jens Hachmeister from Deutsche Börse. Very warm welcome also to Thomas Kropf from Bosch, and last but of course not least, Agatha Ferreira, who is an assistant professor from the Warsaw University of Technology, which I think is great because she can give us the academic background and maybe draw some parallels to what is going on in other regions and other parts of the world. But maybe to kick off with you, Mr. Scharf, I mean, probably most of our audience is aware of that just a couple of weeks ago, the ECB went public with actually doing the Digital Euro project. Maybe to get us all ready and set for the next couple of minutes, could you maybe briefly introduce to what were the drivers, what are your ideas behind the Digital Euro, what is your vision, what the next 2 years and probably beyond gonna bring? And with that, happy to have you all here.
Thank you very much. Thank you for having me. And indeed, in the middle of July, our highest decision-making body, the Governing Council, decided that we will start the project investigation phase on the Digital Euro. It's going to start officially on the 1st of October. So we are very close to the official start, and it will last for roughly 2 years. In that phase, we're going to experiment a bit more. We're going to analyze a bit more on those insights that we have found so far. And that will then also provide input for the next 2 or 3 years when we might enter a project realization phase. This is still not a decision to introduce or issue a digital euro. After these phases, we will have to assess properly whether the potential benefits outweigh the possible disadvantages and then take a profound decision. But maybe I add also the motivation, as you asked for, behind all these endeavors. We identified in the last year and even before 3 main drivers. One is a positive and 2 are insurances against negative scenarios. The first is a positive impact effect on the digitalization of the economy or the society as such. We see that everything is going digital, so does payment, and of course the central bank should and could play a role in there. The second is closely related to that we see that the actual usage of cash when it comes to payments, retail payments, is declining. So this trend has already been going on for years, and it has been accelerated during the pandemic, where people in particular try to avoid contacts with banknotes, which was not actually insecure or anything, but the trend has been accelerated. This has been clearly been seen. Now, we have to be prepared for such a situation that the demand for cash is going down and down and down. We are not driving this development, but we are observing it, and we see that in other jurisdictions like the Scandinavian countries, the situation is as such that roughly 4% or even less sometimes of the transactions are paid with cash. We as a central bank have to provide a means of payment from the central bank, the safest asset you can pay with, also in the future. And we will need some time to prepare and produce something for that scenario. So that's an insurance that the demand of cash goes down too far. Having said that, we will not stop issuing and providing cash. The digital euro, when it comes, would be a complement, not a substitute for cash. The last scenario for which we want to provide in the long term an insurance is to tackle the concerns that we've observed that some big foreign players might introduce a global or regional currency that is so big from the beginning because of their networks that we might actually lose or might be confronted with a risk of the monetary and financial sovereignty of the euro area. So if you have big tech companies with large user network spaces, they could, within very short period of time, introduce a currency that has in theory or theoretically nothing to do with the euro. And what we also have seen already in the last years or decades is that the payment service providers, cards, internet payment services, are more and more, by and large, mainly issued and provided by non-European players. So until now, everything is fine, but there have already been some glitches in the past where, for example, a credit card company from the US was not allowed to accept donations to some political players that were not liked by the government of the US. There were issues with the sanctions in Iran. So there is a concern that the monetary sovereignty of the euro is a bit at stake when there could be a crowding out by big techs. So that in a nutshell is the three main pillars of the motivations. And I guess we discuss more details in the upcoming discussion.
Mr. Scharf, thanks for painting the canvas in some way or sort. If I could sum it up real quick, I mean, this falls short of, precisely hitting what you just said, but I think one key pillar is sovereignty and, ensure that we have a strong euro also in competition to maybe global big techs. And another thing is if I got it correct, is like, to find some sort of cash equivalent that just fits the digital age and the digital needs of consumers, industries. Maybe, Ms. Ferreira, if we could go next with you. I mean, you had a look at so many different CBDC projects around the world. You're covering different regions. Maybe if you could briefly introduce actually what is it that you are focusing in terms of CBDC, and maybe widen our scope. If you hear the outline from the ECB, what do you think we should add to this discussion maybe?
Thank you very much for having me. First of all, it's an honor to be here among such distinguished speakers, and thank you for inviting me to this debate. I'm happy to participate. And I'm glad that you have mentioned so many different projects, because I think it is important to remember that there is no the CBDC, okay? There is no the digital euro, because there are many forms that such digital euro can take. And there can be many forms even that the central bank issued digital euro can take. So digital euro has to be looked at in a broader sense, okay? Not just a very narrow understanding of what digital euro can be. And we have to also remember that as far as ECB is concerned, ECB has a certain mandate and has a certain role to play. And this role is obviously to control the money supply, to be the lender of last resort, to take care of the monetary policy, to secure financial stability, and so on. And these very important objectives, of course, has to be balanced with some other broader objectives, and has to be this digital euro topic has to be looked in a broader sense. And this is an opportunity for this debate. Okay, so we have to remember that as far as the ECB is concerned, the ECB has a certain role to play, and it's not market focused as such. It's focused on individuals, it's focused on its mandate. And there is a reason for that. There is a reason why in the economy, the banks are focused on commercial activity and ECB has a public policy role to play. So there is a role for everybody in this debate. There is a role for public sector, for private sector. And I think that is what CBDC, the digital euro, what should represent is in general an upgrade, a progress that the technology brings, and should be in sync and complementary with other technological advancements that are taking place at the moment. And one of these advancements is the way the internet is transforming, and it's transforming into the internet of value, where we can exchange now the value. And this cannot be designed when this cannot be ignored when designing the digital euro. So there are now payment infrastructures that are being developed, blockchain-based, which of course hugely benefit from the native digital euro. So I think that if you look at various various CBDC projects around the world, they are as diverse as they come, because there is no one true and right answer as to how central bank digital currency should look like. And now we have the opportunity within the Eurozone area to design the most optimal solution to suit our needs as they are at the moment and the future of digital economy.
Thank you so much for adding to this discussion. I think you made a very important and interesting point, which is there is no single right way, but there are several ways, and I think this is so great that we are, adding some ideas here and see maybe where the journey is going to take us. Maybe to continue with Deutsche Börse, Mr. Hachmeister, from a capital markets perspective. I mean, we just heard, it's also the role of the private sector to talk about CBDC and the digital euro. What, from your perspective, would be needed use cases that we have to think about when talking about the digital euro?
Yeah, thank you, Kevin. And first of all, a warm welcome and thank you for having me this afternoon. And sorry for the connectivity problems I was facing. So parts of Jürgen's and Agatha's contributions were cut off. But let me provide you really the view of the market infrastructure, because as a representative of Deutsche Börse, and Deutsche Börse being a market infrastructure provider, we probably have a bit of a different lens than an ECB or the earlier aspects which Stefan Hobbs mentioned from a bank perspective. As a market infrastructure operator, we mainly have kind of two key elements which we provide to capital markets. One is trust. So here we are probably in the same boat as the ECB, so providing trust to capital and securities markets. And the second is really to improve the efficiency of capital markets and securities markets by means of using technology in a regulated frame, and obviously having the market demand and the demand of our clients and of the market participants in mind. And now, taking up this idea of market efficiency, it obviously needs certain, I would call them, ingredients really to take market efficiency to the next level. And taking markets digital means, in our view, apart from some other key elements which are needed, two main, I would call them legs, digital legs. One is the leg around digital assets, and in our special case, digital securities. And the other leg is really the digital, and I would say wholesale payment solutions here. And talking about markets and delivery versus payments. So the delivery function in markets is a key element to market efficiency. And if we want to make markets digital, we need to digitize the two elements of this DVP process. So meaning these two kind of digital legs. And this is why we really welcome the now the kickstart of the CBDC project at ECB. And Jürgen has elaborated on some of the drivers. And when you follow the discussion, you realize that there's a lot circling around the alternative to cash, digital cash, retail payments, etc. For us as market infrastructure operators, it is probably fair to say that we are taking a bit of a different view here, because if you look at payments and wholesale payments in our market, we basically have two main sources. One is central bank money and the other one is commercial bank money. And both of those are the kind of lifebloods and backbones of our markets and market liquidity. And in our view, we really need, and probably here we might have a strong and different view. We need solutions which really are able to cater these kind of wholesale markets. And the CBDC and the digital central bank currency is one of the key elements we need going forward in a wholesale basis. And secondly, probably saying that, and you've talked about use cases, there are multiple use cases, and we have done a lot of use cases over the last years together with market participants, with central banks, etc. A second aspect I would like to point out here is that I would say CBDC, a digital central bank currency and money, does not do the trick, because the variety of different use cases, in my view, requires a variety of different wholesale payment solutions. So we not only need digital CBDC on a wholesale basis, but as well we need ways to kind of mimic digital commercial bank money and others. So we need the entire suite of different wholesale payment solution. The last thing I'd like to point out is really we shouldn't wait till we get it all right. Meaning, I think the journey of the central bank is great, and we fully support it. But I think in the meantime, in order to bridge the time, we should try to work with different solutions and with different interim solutions. Let me give you an example. You have asked about use case one. Recent example, we did a proof of concept and a pilot transaction together, actually with the Deutsche Bundesbank and the German finance agency on what we call the trigger solutions. So really trying to build the bridge between assets on chain or digital securities and traditional payment rails. So in this case, the Target2 payment system. So really trying to work with what is there. And our view, it is really the idea that probably the solutions in future will be solutions which are able to cater multiple on-chain, off-chain, and very different types of wholesale payment solutions in order to facilitate liquidity in our markets.
Jens, thank you for your elaboration, and I think you raised some important issues here. I would like to come back in just a second. Something like, wholesale CBDC, retail CBDC. We have already the trigger solution you mentioned, so we can also in a couple of minutes discuss actually what should the private sector do or is already doing. What maybe should, or how can the ECB add or incorporate? I would be really interested in discussing this in a minute, but before that, I would like to give Thomas the opportunity, who was a brave listener for the last couple of minutes, and maybe add to just what Jens said, providing an intro perspective from the capital markets view, a representative from the industry, may also have a different approach, or at least to say a different angle. So we would be curious what you bring to the discussion today.
Thank you. I would say it's a complementary angle because we bring in a lot of use cases. But I just want to say everything which was said before, we fully support, especially the entry statements of Jürgen Schaaf. What's clear is that to harness the potential of a digital euro, we really need a trustworthy digital money with a user experience which is similar to what I can do with this watch already, and not typing in IBANs and things like that. So this is really a prerequisite. But this watch brings me to, let's say, my perspective, because we as Bosch are in a transformation to become an AIoT company, so really digitizing lots of physical things like cars, like drilling machines, like manufacturing equipment, and putting also AI into that. And the potential for us to having a digital currency in those use cases is huge. We just presented on the International Automotive Fair in Munich an example where a car automatically looks for a parking place, negotiates the parking price, and initiates, at least theoretically, a payment from car to the garage. Or you can, let's say, negotiate the price for the charging of an electric vehicle, and these are use cases which are tremendous and would not only foster our economy and create wealth, but also ease, let's say, the daily life of people. So if you have driven an EV and have messed around with all those charging cards and not working things, then you know what I'm talking about. So this would really give a boost to the economy. I'm deeply convinced. And there are many other use cases. I just give you a couple. So we can sell holes instead of drilling machines. Yeah. So we charge for a drilled hole at a construction site, which is from a B2B perspective great, but you have to charge sub-cent values, which is not possible at the moment. You have to, let's say, complete the payment transaction instantly to keep up liquidity. And all those use cases would be great. So we are talking about flexible manufacturing, where different, let's say, customer use the same manufacturing line, and we could charge for a single welding spots and things like that, and do that totally automatically. So these are really cool applications, but which we need also some kind of micropayment possibilities. And what we would like to see first, from a user or applicant perspective, as industry, we would see solutions which are technology agnostic in the sense that we can use or use a digital currency in the use cases I presented without really thinking too hard for what's behind in the machine. That's really important. And the second point is we would love to see also programmable money. Coming back to the charging use case. So imagine you're driving with your EV to a charging station, and you know if you need that because otherwise you cannot drive further, and it doesn't work. And why not having a system where then the vehicle negotiates a penalty? Like I was driving here, I'm stuck, or even initiates a legal thing, but this is probably a bit too big for a single charging thing. But having this kind of rule-based interactions tied to the digital currency, this would even unleash another level of possibilities in the industry. And last thing, and this is also a catch-up play to let's say regain European sovereignty. So Jürgen Schaaf has pointed out the dependency on some, let's say, big American companies in the digital money transaction domain, but it's also in the data domain. So AI, artificial intelligence, will be key in the future, and AI needs data and data collection. And there would be possibilities to, let's say, incentivize you as citizens to provide data, like traffic signs, like parking spaces, which you collect, and you get rewarded by a micropayment. And then we get this kind of data collection more crowd-based and not in the hand of a single platform company, which would really help in the digitization of Europe. So you see, hopefully you can feel my excitement. So we have to really go fast, and as Jens Hachmeister said, we should not wait until everything is finished and then start. We should, but do more than experimentation. So at least Bosch has left that phase already. So we are looking at scaling use cases, and we have to join forces between people providing the technology, stock exchange, ECB, and the applicants or the users, the industry users, to really jointly define the requirements which we need and move things forward as fast as possible. So digital means fast, always.
Okay, I clearly hear that, getting started rather fast and slow is of importance to the industry. I mean, as you see, we are quite at an early stage. There are a lot of ideas. There are also some first prototypes, some first projects, some MVPs on that issue. We have, for instance, again to mention, the trigger solution, which was carried out, I think, German Bundesbank was in the lead, but please correct me if I'm wrong. So what my question would be, maybe to again bring it back, focusing on a digital euro. We have the ECB on the one hand, we have the private sector on the other hand. Who should do what, or who should focus on what? And again, you also said, Thomas, digital sovereignty is important. Maybe to play the ball first back to you, Mr. Schaaf, again. If you hear all this input, which I guess is not totally new to you, and as we are at such an early stage, and I also know that the ECB is establishing some sort of consultancy board of industry leaders. How are you trying to incorporate this? And maybe you said it's an ongoing project. You don't even know at this stage whether there will be a digital euro, but if you hear this, maybe some sort of timeline or landscape where you see the priorities at this stage.
Yes, thank you very much. And we are, of course, well aware of these arguments. We hear you, if you will. Maybe a few things on that. We see this Digital Euro project as provision of a retail payment instrument. So we are aware of the work that's being done by Deutsche Börse and Bundesbank on the trigger solution that's more in the wholesale area. We will add that layer to investigate on wholesale later within the project. The current setup is more a focus on retail. That's embedded in the mandate. We have the overarching mandate as a central bank to safeguard price stability. At the same time, we have to make sure that payments are working smoothly in the euro area. So these two aspects describe a bit the mission insofar as the digital euro is not supposed to be disruptive in any sense on monetary policy or financial stability or the like. Those areas, it's supposed to be as neutral as possible. So although we have no mandate to protect and maintain the banks, it would be largely disruptive if you would see huge flows from the commercial banks to the central bank balance sheet. So to make that clear, that's not our mandate, but if we don't take care of that, there would be some severe issues. So we have that in mind. We have a public objective, so we are providing a public service, and we want to cooperate with the private sector, in particular as we are aware that many of the innovative solutions are probably produced by the private sector, not by us. So, and even if we now say the template or the ideal we want to copy is currently offered by some private companies, once we are done with that, there might be already completely new solutions. So we also have to be very open for further developments thereafter. As far as speed is concerned, there is a lot of investigation and experimentation going on in the world. Almost 80% of all central banks in the world are somehow investigating in CBDC solutions. We are actually not the slowest. And certainly we cannot compare the ECB to the Central Bank of the Bahamas without, I don't want to sound arrogant, but that's not the same. And we are also in a situation like El Salvador, where the monetary regime didn't work properly and they came up with very fancy ideas. It's different. And money and the provision of money is something you don't play with. We cannot do huge scale experiments that rock the whole society and system. So whatever we're going to provide, if we provide it, it has to be really sound and safe. So thoroughness before speed, but at the same time, quite fast. One point, as the whole thing is in motion all the time, and it will be also in the next couple of years, it makes sense to have a couple of things, maybe not in the first prototype, that come later. One could be, for example, programmable money. This doesn't necessarily be in the first version, so the digital euro 1.0 might look a bit different what you are asking for, but there will also be the opportunity to work with what we then provide, because are we actually in need of programmable money, or do you want to have the programmability of the payment? And does it have, do you want to program, if you want to program the money, does it have to be central bank money, or can it also be commercial bank money? So the appetite for programmable CBDCs might be slightly overrated. There will be ways, and we will see that, so I'm not excluding anything, but there are different ways you can approach this. Last point on the exchange with the industry and the markets. We currently run a call of interest, and applications are sent in by market professionals. We are setting up a group, a market advisory group, with roughly 20-30 people who will advise us, and we try to tap their wealth of experience in the areas where we as bureaucrats might lack a bit of knowledge. So that's going on. These people will be largely independent from their roles or their employers. At the same time, we have some established bodies, the Retail Payment Board, that brings together the supply side of retail payments, demand side, consumer protection representatives and the like. So there we have some institutionalized setup where we also bring industry knowledge, and we have also a lot of exchanges with many stakeholders from the society, the industry, you name it.
Thank you for this. Maybe to play back to Ms. Ferreira. We heard that working thoroughly is important. I think all of us agree on that. Maybe from your perspective, what you just heard, different ambitions, different ideas, or maybe different challenges that the digital euros should solve eventually in the long run. If you compare it to other regions, or where the discussion is in other regions, do you track some differences, something that that the discourse has in common? And maybe that's an interesting question. I'm quoting now from our viewers, so which is basically comparing ECB to Facebook's Libra, now Diem. So whether it isn't a little bit too less ambitious if it wants to compete against those big techs. Maybe from your academic perspective, who has several insights from across the world, how would you assess this?
Thank you very much. And I fully support the statements that my other co-panelists have made. A lot of this I fully agree with. And yes, the DM is a big word, and the Libra, that was Libra before, it has really put regulators around the world on alert when it comes to privately issued stablecoins, at least, and certainly accelerated a lot of research and work that went into CBDC. The whole CBDC idea was accelerated through this project being announced, the Libra project being announced. So as we have heard, there are different and diverse demands from capital markets point of view, from the industry point of view, and I think it's also true from individuals. The key is the choice, the key is diversity, and I think there is a room and a role to play for both CBDCs and other forms of digital euro. So CBDC alone, in the shape and form that we might see coming soon from ECB, might not be enough to address the huge scale of innovation and challenges that the industry faces. So I think there is a room for everybody here, and I wouldn't use the word competition. I think the fancy word now to use is co-opetition, not competition, but co-opetition, so form of collaboration. And even though we need to take time to develop the adequate solution, I do actually believe that time is of essence. So on that, I would agree with Mr. Kropp that we need to act, and we need to act fast, because the nature of money itself is changing very quickly, and the software is eating the world. You hear this thing. So I think that even though the CBD solution should not be disruptive, as Mr. Schaaf has said before, but it should certainly be supportive, and it should be supportive of a diversity of ecosystem, should harvest the innovation, but also to suit the needs and realities of the European startup ecosystem, of DeFi ecosystem, of the needs of capital markets that my co-panelists have also mentioned earlier. So the key is competition, the key is cooperation, and the key is diversity. And certainly 5 years' time or 4 years' time, however long it takes to reach our digital euro solution from ECB, is a long period of time in terms of innovation. So we need to work on intermediate solution that would work for the industry, that would help the innovation.
Well, thanks for that. Let's talk about the timeline in just a couple of seconds. I think, Thomas, you just raised your hand earlier. I think you wanted to add something. Maybe if I can ask you also on a follow-up question. So what do you think, if you hear this, where do you think what would be on the side of the ECB and where private solutions are perfectly fine? I mean, Mr. Schaaf has a point here. There's also solutions in the field of commercial money, maybe. So actually, I see we have to embrace innovation, but now if you think of roles, what do you think, who should do what? But of course, raise the point you wanted to bring to the discussion, of course.
Yeah, but I think it fits well. So my question goes to Jürgen Schaaf. You mentioned the retail aspect very often now. I was somehow lacking the machine-to-machine payment aspect, which is really crucial for us. And I would like to know whether you're also looking at that and have in your, let's say, expert round also representatives which could bring insight what the requirements are on that side, because it's happening at the moment. So companies like Bosch and others, automotive companies, are initiating machine-to-machine payment use cases. And they will become reality in the next couple of years, no matter what. I would love to have a digital euro be directly part of that. If it's not able, the industry will find other solutions. And then we are again in the other, let's say, color of money, which is not the euro color. Therefore, I would really encourage you to not forget, even initially, the machine-to-machine payment. And this works without a programmable euro. So perhaps I was a bit misleading. This is like a vision in step 2 or step 3. Fully agree. But I think this is an important step. And this is a partial answer to what kind of other more commercial private money transaction possibilities exist. So my message is it's happening now, and we would fully embrace any solution which is available.
So actually, if I get it right, you're embracing the sovereignty theme in this.
The sovereignty and the possibility to bring all those use cases I mentioned initially to life, like this micropayment, like this negotiating or automated payment between a car and a charging station or a parking garage. This is happening now because it's a huge pain, especially with the upcoming, let's say, electrification of traffic. The whole charging thing is a huge pain. Parking is a huge pain, and smoothing those use cases and freeing you from grabbing a parking ticket and then not having spare money, or at the end being forced to pay with your Apple Watch, which we probably don't want in the future. These are huge opportunities for Europe, and we should grab them.
So maybe to give a chance to Mr. Schaaf to respond. Do you agree? I mean, you said it's important to work thoroughly, but also, you know, to bring the innovation, because of course you're somewhat in competition to companies from the private sector, as you said yourself. How will you manage to, you know, find the right balance, or how will you approach this?
I would not say we are in competition with private companies. We have to provide the central bank money in a different version. So, like you have now the old world, the analog world. You have the Bank of England that is producing banknotes on plastic. That's full plastic. We are still using cotton-based, paper-like banknotes. So we are moving from analog to digital. But the constitutional element is that it's central bank money. To Thomas, I asked the question back. Do you essentially need central bank money for what you have in mind with a machine-to-machine payment? Does this have to be a liability that is originated and issued by the central bank, or could you do that with commercial bank money? Do you need a blockchain solution, which is a technological problem, or could you build that around on an account-based solution? So there are a couple of challenges and questions that the private sector can answer based on the provision of what the central bank is offering. And so that you can work properly, we will have to make sure that the exchange and the communication with the private sector, the industry, the merchants and the like, that the information will flow. But the intention is not to provide all these services that you are mentioning now. You, the private industry, the industry should come up with solutions that are built on the foundation which is offered by the central bank. And the same applies, Jens mentioned it already, there's already work going on in the wholesale area. Bundesbank and Deutsche Börse is leading there. You have similar projects by the Banque de France. At one point, we have to bring this all together for general purpose CBDC, but this has to be step by step. It has to be phased in, and I have to repeat, there will be interim solutions, and thoroughness still comes before speed.
Thanks for that. Maybe I'm the bad guy here. I have to play the timekeeper, and I think happy you posed a question at our two panelists here. So from an industry perspective, maybe each one sentence. What do you think about that? So why isn't it in the means of the private sector? Do you agree with Mr. Schaub?
So I don't know whether I can make it in one sentence, Kevin, but I'll try. So in my view, clearly it is a joint effort. So cornering the ECB, probably it's not overly fair. But in my view, it is more along the lines of do we have the right set of different wholesale payment solution according to the use cases, which Thomas rightfully pointed out, because finally it comes to the question like, are our markets, which by the way are interlinked, so you cannot segregate capital markets from real economy markets, and all are fueled by the same fuel, which is a payment solution, be it programmable or not for DVP, and then later for the programmable solution. So are we fit and proper for the global competition here, and are we playing up to our potential here if we want to take markets digital? But another point I'd like to make to Jürgen's arguments. In my view, it is a combination, and regulators have set the frame here. If we come up with solutions along certain aspects, meaning a good quality of issuer of digital payment solutions. Second, a clear regulatory frame and jurisdictions under which payment solutions are issued. Thirdly, the question like, what are high quality liquid assets? So if we collateralize, what are sound collaterals which are used? And probably another aspect like, who is the operator of this? Is this a regulated operator? And are those solutions interoperable to other types of payment solutions? This probably a bit eases the kind of pressure on a digital CBDC and opens up the space for more solutions here. But we need this kind of frame, which I think probably has started to be developed by regulators, and at the same time, still we need a bit of leeway and flexibility from central banks and regulators, for example, when it comes to pledging central bank money in order to issue stablecoin and or high quality types of commercial bank money, etc., once we are talking about packed solutions. So it is a joint effort, but it needs flexibility from all involved parties in order exactly to bridge the time gap which Agatha mentioned for a sound interim solution. Sorry, that was not one sentence.
That was a good, sorry to interrupt you here, guys. I think it was a great summary. Thomas, I saw you nodding a few times. I wish I could talk on for you at least for another hour, and I think we're gonna do this just at another opportunity, but I really want to stress what I liked here, and I think everyone in this round is open to that it's a joint effort. And I think it's important to talk about it and to get started. I think we are all on the same page on this. Sorry for not having any more minutes left. Our next panelists are already waiting, but thank you so much. Thanks for taking your time, and I hope we can have this round or a similar round with us at Bitkom and see maybe in a couple of months where we are, where we stand, and maybe what has changed so far. On that note, wish you a pleasant afternoon.
Thank you very much.
Thank you very much.
Really fun.
Thank you.
All right. I think this was quite an extensive deep dive in types of what use cases do we need, what the perspective of the industry is. And now I think if we talk about use cases, it is of course also important to talk about design choices. So on what basis a digital euro is actually built, because the technical details in the end determine what CBDCs or a digital euro can or simply can't do. So I'm more than pleased to welcome our next panelists for the panel called Building a Digital Euro, Design Choices and Their Trade-offs. And now I'm happy to be joined by Ralf Wintergerst, CEO and Chair Management Board from Giesecke and Devrient. Hi Ralf, I hope you can already hear me. We also have Raphael Auer from the Bank for International Settlement. Hi, Raphael. Hello. And Katharina Gerrer, who also joined us at the Digital Finance Conference. So I'm happy to have you back, founder from Immutable Insights. Well, maybe to start with you, Raphael. I mean, you've dealt with design choices quite extensively. Correct me if I'm wrong, but I think you also came up with some sort of pyramid model, you know, to have a look what the needs are and how this has to translate or correspond to the actual design of CBDCs. Maybe to paint the canvas for us, what are the main differences and aspects that we have to bear in mind when talking about designing CBDC or a digital euro?
Thanks for the nice introduction. So I'm principal economist in the Innovation and Digital Economy unit of the BIS, and my tasks there are really to contribute to a variety of our policy work streams. And I also, as part of that job, do some research that sort of scopes out how CBDCs could look like, what the actual approaches are that central banks around the world are pursuing. And in this research, and I need to add here that whenever speaking in public, I'm only going to be speaking about my own research and my own personal views and not those of the BS. And in that research, one intense topic of study is sort of what are the different tiers of how you could design a CBDC from a policy, from a technological, and from an economic perspective, and what are central banks actually doing? So the Cbdc pyramid is this this easy framework that we've thought about, and it really thinks about sort of what are consumer needs. Consumer needs are, first, we want a CBDC to be a direct claim to the central bank in the consumer's hand. So we wanted to have like a cash-like peer-to-peer functionalities that can function without middlemen. But at the other hand, we also wanted sort of to work convenient and smoothly. And in today's electronic payment system, these properties are delivered by private sector intermediaries. So then the central bank needs to weigh these two considerations and think about the operational architecture. What is it that the sort of how do the private and the public sector work together? If somebody could speak up, I don't see anybody moving. If maybe I can get a feedback.
Do you hear us, Raphael?
Okay, very good,
okay.
Very good. Thanks. I just don't see anybody moving, but if you can hear me, that's fine. The and there are different modes of how the private and the public sector could work together. One sort of this, when we started to think about this topic, right, everybody had in mind that the central bank would simply run a payment system on its own. Now, when you think about sort of the variety of tasks and the number of staff that you need to perform these tasks, and you think about how small central banks are compared to financial to the private financial system, it quickly became evident that these sort of forms of what we call direct CBDC are not feasible, and instead sort of the operational architecture needs to be one where the central bank either only like interacts with payment service providers, or where it maybe runs some backup systems. So this is the first sort of the fundamental consideration is about how do I conceptually want the central bank and the private sector to work together. Once I know that, as a central bank, I have to think about sort of what kind of technology do I actually want to run that on? Should that be a conventional database? Should it be a DLT-based one? Then I need to think about, now I have sort of the product, but how do I want people to access it? Do I want them to be firmly identified? So then this would resemble more bank accounts, or do I want to get sort of anonymous options of sort of token-based access, where it's more like a digital banknote that everybody can access who knows a certain password? And last, I want to think about, and that has become really important in the context of the G20 efforts to bring down cross-border payment costs. I want to think about the international dimension. I know my product works in my payment system, but how can I connect it across different currency areas?
Thanks, Raphael, for this introductory notes and raising, I think, many issues. I hope we can dig at least a bit deeper to some of them you just mentioned. But what I really liked is that you pointed out quite clearly it has to be some sort of joint effort, and central banks probably won't be able to do it themselves. I mean, I guess there is no better bridge probably to be built to you, Ralf. I mean, you or in your company, you have a long-standing history in terms of money, starting back those days, or still with cash. Maybe if you can quickly share your view on this, and if I'm not wrong, you also have first experience in different countries in getting projects started. So for us, I think it would be really interesting if you share some insights we can also, I think, use for our European German perspective.
Yeah, thanks, Kevin. Well, indeed, we are a 170-year-old startup. And I say startup because we have been reinventing the company several times with new business models and with getting rid of old business models. And we are just at the surface of still having a business where we produce physical cash. Therefore, we actually know almost all central banks around the world because we work together with them. We know their pain points, we know what they're thinking, we know what actually are issues for them. And at the moment, we work actively together with them of helping them to introduce a central bank digital currency. So something which is an official currency, just the digital format. And I can maybe bring a very live example of the G20 summit in Africa, which was in Berlin like 3 weeks back. And there were several African presidents. And I had the pleasure to have breakfast with the president from Ghana, where we currently run a pilot project. And so the discussion was, of course, not very long, but I asked him, well, what were your key drivers of why do you want to introduce a central bank digital currency? The very first point he mentioned is to keep sovereignty and control over my national currency. Because if all the big schemes come and actually eat away the benefit of my currency, then I'm losing out with my cedi, right? And Ghana is not a very strong country, industrial, so they want to keep the control. So that was one very important point. So it is from what Raphael said, consumer needs, it is also the issuer needs, right? The issuer also has certain pain points. So our experience is that many central banks want to keep control in the digital world. The second thing, of course, is how do they allow, in particular, take Africa, maybe in Europe it's a different thing. In Africa, the central bank wants to have all people having access to the digital world. And not many people have bank accounts. They don't have a banking system as we have it in Europe. Right? So therefore, they have a different challenge of making it inclusive for the people. And whether it's a digital euro or an e-cedi or an e-yuan, it must be inclusive for everyone and not just for a certain audience. So that was a prime thing for him, saying this must be fulfilled. And going back to what Raphael said initially, that determines much of the design choices because it must fit to the infrastructure of the country too. And back to Ghana, Ghana has not a very developed infrastructure, so we must make a solution which fits to Ghana. That means that the central banks will collaborate with the commercial banks, but also eventually with tech companies utilizing their infrastructure for the needed hardware wallets in order to handle the digital currency in the end. But anyway, that's only one example, and there's many examples because almost, and that was also introduction of the entire forum, 86% of all central banks research on how they could introduce potentially a digital currency, and many of them progress. And we are in the middle of that race and having developed a technology for that, which actually cannibalizes eventually one of our core businesses, but better we do it than somebody else. And maybe I get back to you at that point of time.
Good introduction, and thank you for that. And maybe Katharina, to share your initial thoughts. If you could briefly introduce, I mean, you're from a huge fan, or not fan, but you're in the business of blockchain. So maybe to start or to address the elephant in the room, do we need blockchain or DLT-based solutions for CBDC, a digital euro? Or what are the alternatives for that?
Well, I think I wouldn't start necessarily whether or not it needs to be a blockchain or anything else. I think one of the key challenges that we have to face, and it was interesting for me to hear, the two different views from my predecessors. I think to me, we have the big opportunity, but also, of course, at the same time, the big challenge to one step out of the path-dependent thinking on also the institutions and structures that we have now, and think about what we originally wanted to have with money and how we can, think of a system that's supported by technology. Let's, disregard for the moment which technology that may be. What do we want to achieve, and what, serves best consumer needs on the one side, but central bank needs, but most importantly, I think overall economic prosperity on the other side. So I think in a time when we think about transaction costs, when we think about 24/7 availability, when we think about cyber risk, when we think about financial inclusion and lesser discrimination in that regard, then I think we have many purposes that we can serve. And we also have our democratic values. We have an international competition between China on the one side and also private sector initiatives in America. And I think within that plethora of positions and evolving ideas where we are right now, I personally prefer something that is distributed. I personally, think that citizens and legal entities should have a bigger stand and less dependency on intermediaries. So yes, I'm a fan of a distributed version, and I'm a fan of cryptographic technologies that allows a higher level of security. Different than the current payment schemes that we may see in their current challenges. But generally, I'm a big fan of enabling token economy, thinking about what additional benefits the technology can bring, lesser transaction costs, higher security, and in the end, quite the opposite to what most people think, more data privacy for the individual. So those are the factors that I would focus on in the discussion.
Thanks, Katharina. Interesting points. Maybe Esther, Raphael, or Ralph, do you want to directly respond to this or add to the list, maybe?
Yeah, maybe. I think that it's very. There are a couple of very interesting considerations there by Katharina, and I think when we think about the history of central bank digital currency in the last few years, we need to keep in mind, right, that sort of it's true that an early impulse came from cryptocurrencies like Bitcoin, right? People looked at that and they said, oh, well, that's a new technology. Would it be useful for a central bank digital currency? So that's why we saw early experiments using blockchain or other decentralized ledger technology. But then, over time, people realized, well, you're not starting with a decentral design. You're really starting with a design that builds on the concept of value backing by a central intermediary. And so there is no axiomatic need for decentralization. Also, and here, right, what is important is a payment system is of course always distributed, and it can be made redundant and resilient with a traditional setup, and we know these traditional conventional systems can scale well. So there may be some advantages by going to further to distributed ledger technology or not. We'll see about that. But really, what has really come to the fore is like the policy goals. What do you want to achieve? And then, you know, the private sector will come up with a variety of solutions, and those that fit the requirements best will be chosen. And you know, and I think an important consideration is that we start free of legacy systems, try new systems, but whether it will be based on DLT or not, that's anybody's guess at this point.
Yeah, well, I probably would add that philosophy question, whether it's a central controlled system by an institution, is it more trustworthy than an institution or a system or an algorithm which is decentral and controlled by no one or a body of people eventually unknown? And that is quite a dilemma, I think, because I think the initial idea of why Bitcoin came up was not too bad, because it was in the financial crisis. Everybody was giving some mistrust to the institutions issuing money because they were actually doing it too much. And so therefore that concept of having it controlled and having it regulated by an algorithm is a good idea. But eventually, so far, I think the Bitcoins are not a means of payment. They are a means of speculation at the moment. And what we actually hear from most central banks in the world is a fear that the monetary system gets out of hand. So the point the president of Ghana made to keep the sovereignty over the own national currency, from my perspective, is still a good value. And if we talk about a digital euro, at least I want to have the confidence in the institution that's issuing it, that it has a certain control over that currency which is being issued by them, whether in digital form or in physical form. So, of course, it can be given out by a different mechanism, but in the end, I think a trusted institution behind values like currency, I believe, still is a good value.
Well, I think it's a good panel in the way that we don't necessarily agree on all the things, but you pointed out to one dilemma, so I would like to point at another dilemma that's even more fundamental. And that's the question about the individual freedom and who grants an identity. And to me, one of the intriguing things of the blockchain technology wasn't necessarily the peer-to-peer network. It was the idea that anyone could create an identity with which to interact with an economy without any other third party granting it in the first place. So before you even can interact trustless, that sense and that ultimate liberty about an own identity, I think is even more fundamental. So when I would need to have the sovereignty of a central bank as a value on the one hand, and the personal freedom to create an identity, regardless of a nation state, regardless of any institutional framework, then I would actually think that's also a dilemma. And I would probably be on the side to choose the individual identity, particularly when we, look outside of Western Europe, when we look outside of, developed states. There are, frankly, nations on this planet where your right and your human dignity depends on a state defining whether or not you are granted that. So I think that's an even higher value.
I like that discussion, frankly speaking, because we touch upon really the fundamentals of how we design very important things for our life. And I agree with you. I think that liberty, freedom, privacy are values, but I think at some point of time, we have to see that we can survive in this world, where the majority is different than Europe. We are not the majority, we are the minority in the world. So I'm not sure whether our values will succeed or not. At least we should fight for that. I'm fully with you. But back to the fundamental point of our philosophy discussion is what kind of value is driving it, or what kind of institution or mechanism is driving it. In the end, I agree to your privacy point, because I think that's also in the ECB research was a very fundamental point of anonymity and privacy. It was a very highlighted point in Europe here. But I think there's technologies which can actually fulfill that, even if the ECB issues that. But I think now we are back in the technology discussion.
I think this is interesting. I'm also very curious about how this panel opens up our Eurocentric worldview, because financial inclusion indeed is a huge issue in other parts of the country, probably not the biggest one to solve in Europe. I mean, Germany, if it is one thing, it's probably overbanked, but that's a totally different issue at this stage. But maybe one step back before we go into details such as anonymity, what the consumer want. I want to take even a step back, because what I got from today's discussion a bit is that the goal is to have some sort of cash. Like I would put equivalent, not replacement, or some put it should be complement to cash. And Katharina, if you said one thing, it's also about technology and whether we embrace it. So a general question, is it enough, or is it just a function of storytelling, but is it enough just to have a digital form of cash? Would it serve the purpose of CBDC, or would it simply fall short because if I want cash, I use cash? What is your view on this? So what should be the MVP, so to say, in an ideal world? What should it be able to do?
I would like to answer with a picture here, and I think one of when I earlier referred to that, I would encourage us to think outside of the path-dependent trajectory that we've been on over the last decades. When we think about it, something I refer to as a digital cash, we're implying then that cash is also a norm on its own. And I think cash is misleading in a sense because it has this haptic element of the bills and the coins in my pocket. And it's something that then refers to something more. And that's something I have, I own, okay? Now, on the other side, if we think about the overall system, with the inflation, with the other, let's say, economic developments over the past decade, where a lot of economists even 12 years ago would have said that isn't possible, negative interest rates and all these things. I think we really need to be careful also when we, as you said, tell a story to the people, that we once hold on and think about what are we actually talking about. If we're implying this is just, let's say the virtual euro, this is the no euro and it's all the same, and you can use it seamlessly, then that might be easier to understand, but it also implies that a horse is the same as a car. And I'd like to say both are moving, but they're really different things still. They're different types of mobility. And so I would encourage the discussion to not be too easy to just say it's just yet another form of digital cash, because I think frankly it isn't. Systemic risks are different. Technology is different. What it means for value creation also in the economic system is different. And money is more than the bills and the coins. And so referencing it as digital euro or just digital cash, I think is to an extent too easy to an easy story to be told, but too easy for the truth, really.
Thanks for making that point, Katharina. Maybe to forward this point just raised to Raphael. I mean, what is your perspective? Also listening, maybe, or I don't think you had a chance to listen to the panel earlier, as you were in our virtual waiting room. But we discussed with the ECB. So what should be the basis we should focus on? And then I think we had some sort of these two different spheres from the industry, rather moving towards wholesale CBDC, and then we had the ECB with a rather strong focus on retail CBDC. So how do you think this can be aligned, and also adding to what Katharina just said, that we're making it probably too easy if we talk about digital cash, or it is even misleading?
So those are, let me answer these those are two issues, right? One is wholesale versus retail, and the other one is, if we go for a retail CBDC, sort of, is it just a digital complement to cash, as you said? Let me on the wholesale versus retail, I think it's important, right, that that sort of these are not mutually exclusive options, and they're very different animals. So a wholesale CBDC would be a new way of using central bank money by regulated financial institutions that already today have digital money. They have it in the form of accounts, and in the future, with a wholesale CBDC, we could think about, some conditionality of payments and other features, programmable money that will lead to more robust and shorter settlement cycles. But a retail CBDC is a much bigger game changer, right? It's the concept to make digital central money available to the general public, and that doesn't exist today. Consumer can only have a direct claim on the central bank via physical cash, and if you want to have electronic money, you're always having a claim to an intermediary. That intermediary in turn might hold some reserves at the central banks, but such backing is never full. So it's really fundamentally very different. Those are the wholesale, retail. They're not exclusive. They answer very different policy goals. And I think, because wholesale CBDCs don't affect the everyday life of consumers, interest in them in the public domain is much much lower. And that's also why today, right, when we speak about a digital euro or a digital yen or a digital dollar, we think about the retail variant. And here, and that comes back to what Katrina said before, or actually how you introduced the question. I would think really that sort of if we say just a digital complement to cash, that's almost a bit dismissive of what a digital complement to cash could achieve for society, in the sense that cash is really, has sustained commerce for centuries or in some countries even for millennia, but it can't be used in online settings. And in some jurisdictions like Sweden, it's losing its acceptance in day-to-day commerce. And central banks have an obligation to sort of offer a universal payment means. And so retail CBDC could be that universal payment means in the hands of consumers for the digital economy. And the question is not like, should it just be a digital complement to cash, but how can we actually create this? Because cash is pretty marvelous if we think about a few properties, right? From a technological side, it functions really peer-to-peer, and there is no technology that functions as peer-to-peer in a digital world as cash does in the analog one. It has nice economic properties because it's a good means of exchange, but it's not so good as a store of value. So central banks don't disintermediate the financial system when they offer cash. Typically, for example, in the euro area or in the US, people hold like, let's say $4,000, $5,000 or euros per capita in cash, and they hold 10 times as much on bank deposits. So most of the funds stay with the private sector. And last, it has nice properties when we think about anonymity, and there's a trade-off here in terms of enforcing of anti-money laundering, counter the financing of terrorism measures. And in the sense that, right, it's per se, it's an anonymous system by default, but then we, on top of this, install some monitoring guidance, like in a sense, right? Many European countries, you can only pay this much in cash, or if you go to a bank and deposit a large amount, you have to show where it's coming from. But for smaller amounts, that doesn't exist. So it's sort of this system automatically has some tiring and sort of how we balance anonymity and enforcement of certain rules. And with CBDC, right? We need to if one was to launch as a retail CBDC, one would need to recreate these nice technological properties, these nice economic properties, and these nice properties when it comes to AML CFT enforcement. So, and I think it's a very big task, and this will be a major job, and it's not like creating this digital complement to cash is a big feat. And once you have it, you can then think about other means. But it's really it's a very difficult job, and it will require a collaboration across a variety of fields and authorities.
Ralph, maybe what are your thoughts to this? I mean, being like basically home to both worlds, if I can put it that way, and maybe also to pick up on one thing, anonymity. I think you also raised it. I think if you talk to consumers, so people like us who will use it in the end of the day. This was a huge issue, and as we also want to talk about trade-offs, where we draw the line, what does this mean for design functions? But first of all, this discussion in comparison to cash, maybe.
Yeah, thanks for building the bridge. What we experienced when COVID-19 started is that there was a real big run on having cash available in households. And I think we shouldn't probably take Germany as a leading example, or maybe Western countries, but in most countries of the world, the demand for cash was rising dramatically. We recognized, and we have quite strong research on that, because it's in our own interest to understand this world, that there was a 20% higher demand. And much of that was for hoarding it, keeping it away, not necessarily for spending. So there is obviously a fear that the digital world doesn't work always and all the time in each situation, and therefore cash still has a certain relevance. We see it declining in certain countries, but overall Sweden doesn't really make a big difference to the entire world. And at the same time, obviously, we see a big run on electronic payment systems, on the big schemes of the big tech players who actually offer a lot. And then the third part is that in all our discussions with the central bank, it is mentioned that they want to have a central bank digital currency, that's their plans and their basic ideas, as a complementary version to physical cash. So that is the first thing. And the main reason is still inclusion of people who have no access to the digital world, with a number of digital services growing in many, many countries around the world, that they have something equivalently available, which is secured and backed by the central bank. That's the desire so far. In most of the discussion, back to the thing, is it wholesale, retail, general purpose? It's very different, the discussions, but many discussions go to a two-tiered system, that the retail, that's a commercial bank world, and also the tech players are involved. We mentioned China. China maybe has other intentions with a central bank digital currencies. It's difficult to estimate because that's not always public, but they go definitely for a two-tiered system where they involve the public in the end through the tech companies and the commercial banks. So in essence, the physical world of cash still exists. There is a strong demand and need search for finding a good solution for a digital currency. And many countries look for a two-tiered system using the existing network of commercial banks and other players in order to distribute that and keep the circulation in flow. And for my personal view, I think I personally have a tendency to like the two-tiered system more, because if the central bank would hold central accounts, at some point of time, it becomes a very big risk if one institution holds everything of every citizen in a certain region. Maybe that's a little bit too much of a risk as opposed to a more distributed system where more players are involved.
But I think what also the banking industry is raising the potential issue, or that is least talked about, bank runs. What do you think about that? I mean, is this a realistic scenario? I think this is no one liking, but maybe what are your thoughts on this?
If I may start, I'm not a banker, so it's very difficult to understand that. What we have done from our side in order to be a good sparring partner for our central bank customers, we have invested in a company which simulates when you introduce a new payment system, right? It's like they collect a lot of data, they build simulation models of what happens if you introduce, let's say, a digital currency, what could happen to the banking system, in order to get a sense and a rationale of that. And simulation and first field tests are probably the best means in figuring out what could happen. The systemic risk of a bank run, of course, is mentioned typically as one of the highest risks of introducing a digital currency. So, and of course, the policy framework must work against that, because nobody desires that. But Raphael, I think maybe from your research, you can probably add a lot to this.
Yes. So obviously, that was the concern with CBDCs early on. And if you actually look in the evolution of central bank communication on the issue, has been quite a turnaround. This latest, as the 2018, there was a major report by the Committee for Payments and Markets Infrastructure and the Markets Committee that are hosted by the BS and that sort of present like a combined view of many important central banks. And that was very negative precisely because of these considerations that sort of you do not want to endanger a financial system that, you know, works really well and that sort of builds on a very good public-private partnership. In the meantime, I think the people have thought about these policy questions a lot and basically come to the conclusion that the central bank is always in control of the system in such a way that it sort of could limit the systemic impact and could also address the possibility of bank runs. And here I think you know, it can always one thing is it can always adjust the interest rate that is paid on CBDC. It can introduce caps, or if caps are so caps per capita are seen as a too hard measure, it could offer tiered interest rates. That's actually been proposed in an ECB paper, where you know, up to a certain amount of holdings, you get one interest rate, and then when you are above that, a very negative interest rates applies. And there are even like waterfall designs that are axiomatically safe. The Bahamas Sand Dollar has adopted that, where if your CBDC holdings exceed $2,000, the excess is automatically transferred to a linked deposit account. So this limits the CBDC holdings. So there is a lot just by sort of the economic and policy design of a CBDC that can be done. And even if you were to have sort of a run into a CBDC at some point, you have the very same recapitalization models that exist in today's system, right? There can be bank runs, there have been bank runs in the past, and then central banks have this important function as a lender of last resort, and any inflow they receive into the CBDC, they simply recycle to the banking system so that the net amount of funds available to commercial banks stays constant, and sort of via that mechanism, you could never have a self-reinforcing crisis. So, you know, given this variety of means that are available to policymakers have become much less concerned about these dangers, and have really focused on sort of what's the positive use case for a CBDC, how can we make it usable that it's accepted, and how could we operationally design it to involve the private sector also on the payment side.
Thanks, Raphael. And I think you mentioned a few aspects that have to be thought of or are currently thought of, you know, to maintain certain shortcomings or trade-offs. As we are running out of time, and I want to give Katharina again the opportunity for really a brief closing remark, you know, to all the central banks out there, what would be your wish, what design questions should focus on, or what it should be definitely based on when talking about the digital euro or any CBDC?
Well, I'm generally enthusiastic about the opportunities and the benefits that will bring. So besides all the risks that we've, you know, touched upon and that are important to consider, I think all the benefits that a central bank digital currency can bring in terms of economic transparency, you know, fewer costs in the society, higher GDP, higher productivity, higher security. There's so many positive aspects that I think it's important to be excited about, you know, what it can bring to the economy in the coming decades. So in the end, I think, you know, be open and creative and try to utilize those benefits to the maximum need of the people. And then I think we're a big step ahead.
I think it's always great to end on such a positive note. So thanks, Katharina. Thanks, Raphael. Thanks, Ralf. Sorry for not having more time, but again, I think we're going to talk on this pretty soon as there's so much development going on. Thanks for taking your time. Have a pleasant afternoon. And maybe if you want to listen to a few sessions that come up, you're invited. And I think you're going to have some great insights after that. So thanks for taking your time. And now, the first half of our Digital Euro Summit actually has come to an end. So this is why I want to welcome Patrick, my colleague, back on stage, who is now introducing, after we have discussed about CBDC and the digital euro predominantly. Maybe you can give us a quick heads up, what is to be expected in the next 2 hours?
Yes, thanks, Kevin. It was fascinating to listen to you, fascinating discussions around central bank digital currencies, both on the panel that discussed the motivations and the use cases around CBDCs, but also just now the panel around the technical choices around the design and their trade-offs. So the first half of the Digital Euro Summit was really focused on innovation from the central banks, the central bank digital currencies, which are broadly discussed. The second half of the Digital Euro Summit, which we will kick off basically now, will more focus on private sector innovation in the field of money, in the field of finance. And to be honest, I think there's no better way to kick this second half of the Digital Euro Summit off than with the keynote of Christian Catalini, who is a co-creator of Diem and a chief economist of the Diem Association. As everyone basically knows, all our listeners know, it was the announcement of the Libra project, which is now called Diem, in June 2019, that sparked a lot of discussions around central bank innovation, around innovation in the field of money in general. So thank you already for that, for sparking the whole discussion, for definitely accelerating the pace of innovation in that field. And I'm very much looking forward, Christian, to your keynote, from cryptocurrencies, stablecoins, and Diem to CBDCs.
Thank you. It's a real pleasure to be here. And yes, as you said, we do think of private sector and public sector efforts in this space as complements. And hopefully in my talk, I will cover that. Let me share my screen so that you can follow along with my slides. I will touch on some of these points briefly and happy to discuss in the Q&A. From an economics perspective, what gets people like me excited about this space is really the technology can reshape markets. We often talk about blockchain reducing the cost of verification, lowering the cost of really digital transactions. But really, there's a more important component which relates to competition and innovation. This is a technology that can enable much more competitive, open, and innovative markets. And a lot of this relates to how they bring interoperability and really the ability to move between different networks and different assets in a seamless way. Current payment system is extremely fragmented and there's a lot of friction. There's a number of walled garden solutions that keep users or merchants kind of captive to that system. And here is really an area where stablecoins such as Diem can make a big difference. And more broadly, this is part of broader changes in the economy, which range from stablecoins to decentralized finance to things like non-fungible tokens, so markets for digital online content. And often you hear that the technology is all about removing intermediaries from the picture, but it's really changing the nature of intermediation and where intermediaries can add value. After all, intermediaries are often needed to ensure that markets of any type really reflect society's values and principles. When you think about stablecoins, that relates to issues such as AML, compliance, and sanctions concerns. But of course, when you think about decentralized finance and some of these new emerging markets, also financial stability and really ensuring that consumers are protected. We believe that there's a strong interplay here between software and upgrading the software and code and technology behind all of these platforms and the institutions, so the regulatory and legal frameworks that can support really safe and compliant experimentation in this space. There's a lot of kind of long-term benefits of the technology, and this is kind of something to look forward to across a number of markets. This is technology that can really bring more competition in segments of the economy that have been somewhat close to new entrants for a long time. And I've already mentioned interoperability as a key ingredient to enabling true competition, so that the consumers on a small wallet can pay and receive payments from consumers on a large wallet, and merchants can really migrate between different solutions without getting locked into any of these particular services. But more broadly, over the next few years, I think we'll see a broader unbundling of services related to credit, banking, and financial services that have been bundled together because of historical reasons. So it's a technology that has a lot of potential in enabling concepts like privacy by design and allowing compliance solutions that still protect consumer privacy from a provider or from a third party. In general, I think the public sector should also look forward to more transparency and more accountability and auditability in all of these systems. Which leads me to stablecoins. This is a segment that has really exploded in growth. There's a number of dollar stablecoins that have now multi-billion-dollar market caps. And that growth has not always been met with proper designs. And in fact, if you look at the words of Governor Brainard from the Federal Reserve, she compared the explosion in stablecoin activity to the wildcat banking era, where the US experienced a lot of inefficiency, fraud, and general instability in the system. Governor Brainard is exactly right, and to some extent, the word stablecoin has really become a misnomer. I don't have the time in this short segment to really go into the depth. We have a paper that discusses this in a lot of detail. But under the umbrella of stablecoin, there's a number of different options today, from algorithmic stablecoins to crypto-backed and collateralized, to stablecoins that essentially can invest in a variety of assets. And those assets are unlikely to maintain their value, for example, in stress market conditions. So think about 2008 or even the recent COVID crisis. So with Diem, we've been really innovating in robust stablecoin design. And what's interesting is to see that some of our ideas are actually now already shaping the landscape. When you think about a lot of the experimentation, one of the challenges that many of these stablecoins face is that when you have an algorithmic model, that stablecoin could literally collapse to zero and lose all of its value in a negative market shock. We have this kind of graph that tries to lay out all the different stablecoins designed on two axes, how they are volatile against the reference assets, say a digital dollar or a digital euro, and what is the likelihood that they can fall into a dead spiral. We've taken all of these design considerations in mind in designing the reserve for Diem, but also importing much more traditional frameworks. Think about Basel III, so things that have been used in banking already and can be really applied to stablecoin. This leads us to a stablecoin design that's novel because it's really optimized for retail and merchant payments. That covers things like the design of the reserve, ensuring that it's really stable even in stress market conditions, but also compliance. We think an important role is really preventing financial crime on the network and ensuring that we have robust controls that allow good actors to use the network at a very low cost, but also keep bad actors out of the system. Why you may want a stablecoin? Well, because even in countries like the United States, this is a graph about the G7, there's a very large share of the population that's either unbanked or underbanked. 7% on average does not have access to the financial system in the US, and that percentage is more like 15% when you look at the bottom of the income distribution. So massive disparity and perpetuating kind of inequality because of the cost of accessing really basic banking and payments. When it comes to the economic design of Diem, a number of important dimensions. I've already mentioned kind of the trust in the reserve and in the coin, but also a design that can support competition and a leveling playing field. I'll talk a little bit more about this. When it comes to our reserve, we were the first one to really stress the importance of high quality liquid assets. So if you think about a Diem dollar, 3 months or less US Treasuries and then cash with banking institutions. That design is important because otherwise some of these stablecoins today could naturally break their peg if there was an asset dislocation in any of the markets they operate in. Now, what's interesting is that as we started talking about this now for over 2 years, you're starting to see some response from the market, maybe also because of regulatory pressure, but there's increased transparency and some of the leading stablecoins are starting to kind of really imitate the Diem design, although there's a lot of room for improvement. From a competition perspective, we strongly believe that for Diem to succeed and for the network to be a force for good, it needs to be modeled after open technology standards, the ones that we come to use for the internet. So definitely not a walled garden. Interoperability at its core to encourage competition, again, between small, large players, incumbents in the financial sectors, incumbents in tech, new players and startups coming onto the system. And the ideas are really the economic principles of reducing switching costs, reducing barriers to entry, and driving competition so that consumers and merchants can really win on the other end of the equation. We're also the only stablecoins that has publicly committed to retiring our coins whenever there is, something like a Cbdc. So you could imagine if a digital euro comes to life, we would essentially focus on the payment rails and on providing programmability and other functionality for payments on top of the digital euro or the digital dollar. But we don't plan to retain our coins. Our coins are really a retrofitting exercise in this phase where you do not have CBDCs. We strongly believe in a complementarity between public sector and private sector efforts in this space. So you may wonder, why build another stablecoin? Well, we don't believe that standards for consumer protection when it comes to reserve design or even financial crime compliance are high today. And so there's a massive area for improvement, and consumers and merchants will really benefit from what we believe will be the first stablecoin to meet those high standards, but also building a longer run public-private partnership. You may have seen, in 2020, Bank of England released a very detailed discussion paper on CBDCs, and in that discussion paper, there's a detailed discussion of the complementarity between public sector efforts and private sector efforts. On the US side, of course, different governors at the Fed have come on very different positions. And for example, in the words of Governor Quarles, there's even a question of if you can build robust, well-regulated, well-structured stablecoins, do you even need to deploy a CBDC token? Our view is that CBDCs and stablecoins should be complements, not substitutes. And in fact, they can really play to the strength of the public and the private sector. In a recent piece that I wrote with Zaid Masari from Davis Polk in the Harvard Business Review, we really try to think through what are models for robust and sound stablecoin design. And we identify at least 3 options. Happy to discuss them more in the Q&A. They really build on the concept that today, 95% of money in developed economies is private. Of course, that's a public-private collaboration, and often there's public guarantees, whether it's FDIC insurance or other constructs in other countries. And to some extent, you think of stablecoins as new, but the concept of separating monetary and credit functions is more than 80 years old, at least in the United States. So in the piece, we offer at least 3 options for upgrading our money system: true stablecoins, deposit stablecoins, and CBDCs on multiple rails. Now, again, these are not mutually exclusive, and you could imagine different countries experimenting with different models, potentially multiple models at the same time. So really briefly, true stablecoins, again, the piece goes into a lot more detail. These are kind of narrow bankish-like issuers where you're holding 100% reserves in HQLAs, very much like the DM design, and you're really ensuring that consumers have a direct claim against the issuers, and that those assets are really taking precedence and are prioritized over other creditors of the issuer in the case of insolvencies. These are models that work really well for medium of exchange coins that are used for payments. You can also think of a model that builds on current banking frameworks and is much more of a deposit stablecoins. Now, this could inherit some of the protections that we have today, whether it's FDIC insurance, as well as the corresponding banking capital requirements. But what's interesting here is that you can have coins that also work more for traditional banking use cases. Now, there's some challenges with this approach, and the true stablecoin one might be a faster one to market. But all of this, to some extent, becomes less relevant once you have a token issued by a central bank. As I've mentioned, we've committed to phasing out our tokens whenever there's a CBDC in a region we operate in, because we do believe that in the long run, the best coin will always be the one issued by a central bank. And so we want to offer programmability and payments on top of that. And we hope that central banks will explore ways to move their tokens or their coins, not just on public sector rails, but potential multiple competing rails. This really plays to the strengths of public versus private sector. Of course, when it comes to monetary policy, stability of money, providing sound money, that's the remit of the public sector. And also setting standards. I think right now there's going to be a really important role for the public sector in setting high quality, high bar standards for reserve design, financial crime and compliance, and a number of other dimensions like non-interference with macroeconomic stability for all of these stablecoins. Privacy is another issue where the public sector, of course, can contribute a lot, and also harmonizing frameworks across different jurisdictions. That's kind of the area where we see public sector effort having the highest returns, especially when you think about something like a digital euro. On the private sector side, I think the private sector will always have an advantage in developing those consumer and business-facing products and services. So when it comes to time to market, when it comes to experimenting with programmability, those are areas where the private sector can take a bit more risk, given that the public sector solutions likely will have to be extremely resilient, extremely conservative in terms of the functionality that they can deploy. So I want to end this short presentation by really stressing a key point. And here, you're seeing a picture of the early internet. I think that's a really useful metaphor as we think about stablecoin and CBDCs. You hear often that the two are competing with each other. I think that couldn't be further away from the truth. Well-designed stablecoins, very much in the history of a public-private collaboration, should be seen as strong complements to public sector efforts in this space. Very much like the commercial internet was built on top of decades of R&D and work by the public sector, and was really able to achieve its potential because of that complementarity. So as you think about how to regulate stablecoins and how to bring some of these efforts into this space, again, I think there's massive potential here for improving competition in payments. Payments today are extremely uncompetitive, and if you're a small and medium business, you're paying very high percentage fees to either the current card rails or other alternative solutions. We can improve this by bringing true interoperability and true competition to a lot of these segments. Similarly, for consumers, I think there are vast segments that are either unbanked or underbanked and underserved in a number of countries, including developed countries like the United States. And so there's really massive room for improvement. Thank you very much for your attention, and I look forward to discussing this during the Q&A.
Thank you very much, Christian, for this great introductory presentation into the world of stablecoins. We would now like to pick some questions up from the chat, from the audience. So to all the listeners, feel free to ask your questions directly in the chat. And first and foremost, I think most of our listeners are very interested to hear an update, a heads up maybe on where the Diem Association is standing, on what to expect in the near future from Diem.
Yes, so we're heavily engaged with a number of regulators across the globe. We made it really clear that we want to be the one stablecoin that is not only actively engaged, but also responsive to feedback. I would say that the last 3 years have been really a journey of working through regulatory feedback and improving our design on a number of dimensions. So we're still engaged in that process. I don't have any precise news to share at this moment. And part of our timeline is really driven by the key regulators we're engaged with.
All right. I have one question popping up here in the chat. There's one listener that is interesting to hear on how Facebook's governance may be changed also around the shift from Libra 1.0 to Libra 2.0. Were there any changes done in the form of governance?
Yeah, absolutely. And this was part of the overall plan, right? So for Diem and at the time Libra to succeed, it needs to be an independent organization, and it really needs to fulfill that mandate of distributed governance. Today, we have more than 26 members, and these members all have one vote. And in fact, Facebook is not our largest investor. We think that's a really important feature, and over time, we're working to expand that governance to represent more regions, more verticals, traditional financial institutions and banks. We think that that's going to be really the strength of the network. I think if you look historically, there's been a number of efforts in payments that started as kind of broader coalitions, but we do really need to imbue our governance with the right principles so that over time, it can really match the values of those open internet protocols. If we cannot recreate the best features of competition on our network and across our network and other networks, then the project will be a failure.
Mm. Interesting. Christian, you already mentioned how big the stablecoin market is in a certain sense. We have billions and billions of market capitalization of certain stablecoins in the market, Tether, USDC, and others. What would be interesting for many to know is what is the key differentiator with a Diem stablecoin? Where do you see still the need in the market for an additional stablecoin? What do you think is the USP when it comes to stablecoins issued and offered by Diem?
Yeah, that is an excellent question. So first of all, a clarification. When you're looking at massive growth in market cap, that is all driven by DeFi and decentralized finance. So there's a number of use cases that are being experimented in that area. They present a number of challenges, and I think regulators are kind of focused on that, both from a consumer protection and a market integrity perspective. DeFi at scale is also a risk for the stability of stablecoins, and that's why Diem, for example, has a number of provisions to prevent additional leverage from coming onto the network. This is what is commonly known as shadow banking. And shadow banking has a number of challenges that regulators are very aware of. But beyond the growth in DeFi, I think if you look at actual growth in retail and merchant use cases, there hasn't been much. And that's exactly what DM is focused on. DM is focused on making payments more competitive, more interoperable, more open and programmable in the long run. And so really allowing a small merchant, a small business to accept payments at a very low cost.
Great. One last question for the remaining 30 seconds, if you manage to do so, Christian. Will DM still run its own blockchain?
Yeah, so part of our value prop when it comes to compliance is the combination of DM BFT, so our blockchain, which has a very high throughput and has the ability also to implement natively things like the travel rule, which regulators are also very focused on. So we think of the integration of coin and network as an important phase of the project. But of course, as I've already mentioned, in a future where there is a digital euro or a digital dollar, we would stop issuing our coin and replace it and potentially move it on DM rails.
Fascinating. I'm sure we could talk a lot more about DM. It's really exciting to hear what is happening behind the scenes. I'm pretty personally also excited to see what will happen in the next 12 to 24 months. Thank you very much, Christian, for your amazing presentation, for your time today. And I'm sure we will see you again in a future event at Bitkom, maybe in a couple of months, and you will have more news to tell us.
Thank you, my pleasure.
Thanks. So after this great overview into the worlds of stablecoins and private sector money, we will try to even dig deeper into that topic in the following panel, which will be a deep dive on stablecoins. I am very much looking forward to the panel, which is titled CBDCs and Stablecoins, the Race for Mainstream Adoption. And I'm especially glad and honored to be joined by 4 absolute experts on the topic. Here with me are Sonja Davidovic, who is an economist and a digital expert at the International Monetary Fund. I'm joined by Dante Disparte, who's the Chief Strategy Officer and Head of Global Policy at Circle. I'm joined by Kai Sheffield, who's VP and Head of Crypto at Visa. And last but not least, by Rune Christensen, who's the co-founder of MakerDAO, the project behind the decentralized stablecoin DAI. Hi, everyone. Hi.
Hello. Hello.
Let's directly jump into the topic of stablecoins and CBDCs, and maybe let's start with one of the more basic questions. How would you define stablecoins, and what kind of different types of stablecoins exist currently on the market? Maybe Rune, do you want to kick off the panel?
Sure. So yeah, nowadays stablecoins are a really hot topic, and I think when people sort of talk about stablecoins or use stablecoins in their daily lives currently, it's almost always what's also called a centralized stablecoin. So it's basically this concept of a token on one of the popular blockchains, such as Ethereum, that's pegged to $1, and then it's backed by basically sort of similar to how you would back, we used to say it's backed by $1 in the bank. Now we know that that's not entirely the case, but it's pretty much the case that it's backed by sort of the established financial system and then transported onto the blockchain. And then you have decentralized stablecoins like the MakerDAO protocol's DAI stablecoin, where the difference is essentially that the stability and the peg to the dollar is essentially sort of crafted on the blockchain itself. So you don't have this sort of external source that's fundamentally the thing that's backing it and keeping it stable and keeping it close to $1, but rather you have this entire protocol that's running on the blockchain, that's automatic, it's autonomous, it's controlled by a public governance process, and then it actually it does some of the same functionality that actually banks do, including also providing credit, so also doing lending. And this then allows it to create and stabilize a currency, a blockchain token that is pegged to the dollar.
Dante, as company behind Circle, basically the second biggest stablecoins in terms of market cap currently in the market, how do you look at the stablecoin market right now? What is your perspective around current dynamics, on how the market evolved in the last 12 to 18 months?
Yeah, no, thank you. It's great to be a part of the conversation today with such an expert group. So the key is, think about what you cannot do with a dollar or a euro or a pound sterling in the context of a pandemic. And in some ways, the stablecoin, in our case, USDC, which is effectively a dollar reference stablecoin on the open internet, competitive across multiple public blockchains, leveraged by companies like Visa and a number of others that would be traditional global financial institutions. It's effectively importing the fundamental trust of the dollar, the underlying currency, and with it importing the type of monetary policy, the type of approaches that central bank independence would require, and then empowering that with the power of the internet, right? So your financial needs don't take bank holidays, your financial needs don't go to sleep, they're on 24/7. And yet, as we saw in the course of the COVID-19 pandemic, even so-called fortress countries resorted to whatever methods they could to provide for financial interventions. And so it's not surprising that you've seen an enormous amount of growth in the year and a half of COVID-19 of not only digitization, we've accelerated the pace of digital transformation by at least a decade in the course of 1 year and a half of this pandemic. But with that growth, you've also seen increasing adoption and increasing mainstreaming adoption of digital currencies, stablecoins, and the blockchain economy. So today, USDC went from $4 billion in January to nearly $30 billion today. And so much of that is powering not only the crypto native economy, but increasingly real world payments and use cases.
Mm. Yeah, it's fascinating to see USDC's growth in the last 12 months, which is also catalyzed by some pilot projects, which are basically also driven by companies like Visa. And that's why I want to get to you, Kai, and listen and hear your perspective on the topic. What is Visa's stance on stablecoins? How does Visa look at integrating maybe the benefits of stablecoins, the innovation of stablecoins into its own payment offerings? How do you approach the whole topic?
So today we support 160 currencies on our global network. And we expect that many of those currencies over time will become digitized in some way. And we're seeing significant innovation from entrepreneurs and developers all across the world that are building new financial and payment products. We think increasingly developers are the customers for payments. And now we just see a ton of interest from developers in stablecoins. And so they're building new digital wallets, new financial products, and they're coming to Visa. And we want to help be a bridge between this new class of crypto native fintechs and digital wallets and our network of 70 million merchants. And so we see a stablecoin not really as a new currency, but just a new form factor of an existing fiat currency. And so it was important for us, as we see the growth and interest in stablecoins from many of the next generation of issuers, that we can actually upgrade our infrastructure and support stablecoins on our network, in our settlement systems. And the same way we use many currencies today, we use many different networks to move and settle transactions. We see stablecoins as just additional form factors and blockchains as just additional networks that we can plug into our global infrastructure.
So in that sense, if I hear it correctly, stablecoins would basically be complementary, in your opinion, to CBDCs, for example, as just another form factor of money. And I would be interested in hearing your opinion as well, Sonja, and the opinion basically of the IMF, which I know has covered those topics also extensively. How do you think that stablecoins on one side and then central bank innovation in the form of central bank digital currencies, how do you think those two innovations relate to each other? Do you think that there is a competition in the market for certain use cases? Or would you say that there's a clear divide between where a stablecoin might make sense and where a CBDC might make sense? What is your view on that topic?
Hi, Patrick. Thanks so much for the invitation. Great to be here. Actually, we're just talking about that in the breakout room before coming on stage. And I think that one of the stable coins, Libra at that time, now Diem, was definitely a impetus for central banks to start thinking, accelerating their work on CBDC. So it was a wake-up call for sure. But I don't necessarily think that there is just competition going on. I think that in the future we'll see a lot more synergies and some forms of collaboration that may occur between the two. And first, I want to say that just as we have different ways of paying for goods and services now, so we will have the same forms of payment, or just in digital form, for in the future. So we will be using, I imagine, CBDC just like we're using stable coins or whatever, like we have now. We have credit cards, we have Venmo, PayPal, all sorts of means to pay for what we're buying. So I believe that central banks should think about CBDC not just a currency, but sort of a backbone infrastructure that will provide for growth of an entire ecosystem on top of it, right? Because central banks are not necessarily going to hit every use case. They're not going to be at the forefront, perhaps, of like the latest technological innovation, but they can certainly provide the trust and credibility of a currency, and they can provide the guardrails, so to speak, for the private sector, for stablecoin providers to build on top of. So I do think that that's something that a lot of times gets neglected in the conversation. We're just speaking of currencies, but I see CBDC more as a sort of the infrastructure at the back end of what can be used to build out those use cases that probably stablecoin providers are more apt to or providing than central banks in a lot of the cases. I mean, yes, the central banks will keep the issuance of the currency under their wing, but certainly the distribution and the provision of payment systems and networks will be left out to the private sector. So I do see a lot of collaboration more than competition in the future.
Yeah, especially if you look at where stablecoins the most used stablecoins right now are used for. It's basically for DeFi, for borrowing, for lending, but also for trading on centralized exchanges, especially Tether, for example, and to some degree in international payments. I'm wondering, Dante, I know that you are in close talks also to the US government, to the Fed. I'm wondering, do you see any use cases where you would say, as also the issuer of USDC, it might make sense for a certain use case to issue a CBDC, or would you say that privately issued money and privately issued stablecoins like USDC are best positioned to address all kinds of different use cases in the future?
You know, it's a great question, and I think my views on central bank digital currencies are at least on the record, and I could say that one, the CBDC quote unquote versus stablecoin debate tends to ignore the fact that the vast majority of money globally in circulation today would be construed as privately issued. Banks issuing money through the two-tiered banking system, credit creation, money that rides in the form of being enshrined on global credit card networks like Visa and what Kai described a moment ago. The reason the dollar is the global sort of currency of choice is in no small measure is because over the course of all the periods since the Second World War, at least, we have had cooperation, public-private collaboration, and a series of consortia emerge around how money moves, whether it's on the internet, plastic cards, or other methods. And I think this wave of blockchain-based payments and money is really a reflection of exactly that history and that past. So I would say all of the use cases that are supported today and more of what would be the use case for a dollar if it existed on the internet can be provided for. The other quick point I would make, and this is borrowed from a colleague from the Bank for International Settlements, is that if you went to regulators today with an innovation called cash in the middle of a pandemic, they would likely not approve the innovation because it's opaque, it's backward looking, and in a public health emergency, it could spread disease potentially. And so I think this exact innovation around money that is trusted, that can also live in internet form, is appropriate. And the central bank should not run science experiments on money. It should be a free market activity.
Mm. Yeah, I totally agree with that. And I would like to open the discussion not only to basically to the distinction between stablecoins and central bank digital currencies, but as we heard in the keynote before this panel and also on this panel, there are just multiple types of different stablecoins already in the market. So what I would like to know from Rune as the project behind DAI, the decentralized stablecoin, is where do you see basically DAI positioned? What do you think is DAI's future in the stablecoin market, and what kind of use cases do you see best addressed by a stablecoin such as DAI compared to maybe other kind of stablecoins, more centralized kind of stablecoins?
Yeah, you could really think of decentralized stablecoins as sort of the version of stablecoins that are really tied all the way back to the emergence of the blockchain technology altogether, and like Bitcoin and these sort of, I mean, this original idea that actually was rooted in the 2007 financial crisis, right? That essentially was likely the reason why Bitcoin was developed. Of course, we don't know for sure, but the early community in crypto was generally focused on this idea that there are these, you know, like this, the financial crisis has shown us that there are these sort of fundamental contradictions in the traditional financial system that sometimes emerge in this way, right? Where you have things that shouldn't happen and yet they happen anyway. And then if you're sort of a regular person, you're not a part of the power structure, you feel really frustrated because you're like completely left out essentially, right? And then that's sort of that's the I guess you can say the ideology behind decentralization in general. And then that led us to things like decentralized finance, the idea that we should build financial infrastructure that fundamentally is completely open and completely transparent, and is, you know, is built in a way where there isn't some sort of small secret closed group or something that can control these things, right? And I mean, and then over time, it turns out it's a little bit more complicated than just a bunch of ideology, right? So in practice now, actually, all of these like DeFi projects, including Maker and the DAI stablecoin, are now actually looking at how can you then sort of from this original positioning of being on the outside, how can you now look at interesting ways to actually integrate and interface with the existing system? And sort of an interesting example of that really playing out in practice is how the Maker protocol and the DAI stablecoin very heavily rely on the USDC centralized stablecoin in order to keep itself stable. And by doing that, it's been able to like vastly improve its stability, right? And basically peg it right on the dollar, right? But I mean, the important thing is still that this sort of approach and focus on openness is what has led us to things like, I mean, the Cambrian explosion in DeFi, right? Where you have this permissionless innovation, money Legos, people like to call it, right? Where you have hundreds and even thousands of financial applications all chaining together, building on top of each other, and, you know, an environment where anyone can participate, right? So you have, you know, these sort of rags to riches stories of you know, Indian teenagers just writing some code with no connections, no VC backing, you know, nothing essentially other than their ability to code, and then a vision for a product, and that actually can catapult them to sort of some of the world's top DeFi and even financial projects in the world. And there's also there's another example of adoption of DAI in Argentina, where basically DAI, we were one of the very first stablecoins. And so we actually focused quite early on trying to basically educate people in Latin America on how they can use this technology. And that actually resulted in quite a large scale adoption of the DAI stablecoin in Buenos Aires in particular. And it sort of actually feeds back to this concept and this ideology of money that is not controlled by an elite, but is actually instead just controlled by a neutral protocol. Because the entire problem with money in Argentina is the sort of the lack of trust in the authorities and the hyperinflation that's been created there. So ultimately, that's really what decentralized stablecoins they cover. They cover sort of the, you know, the alternative, all of the space where the existing system fails to function correctly, or it just isn't able to cover. And in some cases, it's also just able to move faster, right? And make sort of more flexible decisions that are not encumbered by kind of all of the bureaucracy and all of the systems that exist within traditional finance.
Yeah, it's amazing to see, and you mentioned Argentina, India, and other real-world use cases and real-world evidence on how stablecoins, especially decentralized stablecoins, and can basically help with financial inclusion, with the goal of financial inclusion. And just a quick follow-up question for you, Rune, since you mentioned that DAI is also heavily collateralized by USDC. Would you say that for the future, for the near future, the high degree of centralization in the collateral could also become a risk factor for DAI and for MakerDAO?
Yeah, so the concept behind the DAI stablecoin is basically to have this sort of on-chain, blockchain-based, autonomous computer program that kind of runs a process that's a bit similar to a bank balance sheet, essentially, right? Where it has basically currency in circulation, and then it has a whole bunch of assets as collateral that back these outstanding stablecoins. And the core idea is that the way that you can actually do that in a way that's not risky and risk actually blowing up people's money is that you diversify the risk. So you don't just use one type of collateral, you use all sorts of different assets, so that even if there's a problem with some of the assets, then the rest of them will be of a different type. So they're unlikely to sort of suffer from the same type of issue. And so from that perspective, today USDC makes up more than half of all the collateral. So from the perspective of diversification, that is definitely that is unintended, and it's essentially sort of a stopgap measure where right now it's just the easy way for the system to basically store capital in a very safe way. But the maker community, sort of the governance process that controls the protocol, is hard at work figuring out how to allocate all of this money, essentially. But it's actually not going to, there's certainly some of it that's flowing increasingly into decentralized collateral like ETH and Bitcoin. But actually the more important focus is actually on what we call real world assets, which is, basically integrating back into the real world and using assets from the real world as collateral. But the way to do that correctly is with proper diversification. So we're talking about things like setting up trusts in top jurisdictions. Obviously like Delaware, that's a really obvious place to store money, but also like the UK and there's a whole range of these kind of high quality specialized jurisdictions that are good for holding collateral. And then if you diversify across enough of them, and then also diversify the actual assets that you hold in these trusts, then you can actually begin to construct like a really interesting system that has, I would say, all of the positive qualities of the existing financial system and how banking works today, except for the government bailout part. We're not going to be able to get that piece. But then also with a whole bunch of other really interesting advantages, such as the fundamental transparency and the stakeholder-based governance.
Yeah, we talked a lot already about different stablecoin, basically criteria such as decentralization, transparency, governance, the underlying technological infrastructure. So what I would like to know also maybe from you, Kai, is when you look at different stablecoins and how you could integrate them into your payment products and services, what are the kind of quality criteria you look closely at? Is there some kind of due diligence process, and what is highly valued maybe when you look at stablecoins, and what are maybe red flags when you look at some stablecoins that would basically prevent you from integrating them into your services?
Yeah, so for us, our general goal is, we're currency agnostic today. We support the currencies that our clients demand, and we want to be digital currency agnostic. And so it starts with, where is there real use and activity and demand? Where are clients coming to us saying, I'm keeping my corporate treasury, in this stable coin, I'm paying my employees, I'm paying my vendors in it, can I settle my obligations with Visa in it? So that's step one. Then step two is, okay, what is the governance, of that stable coin? How are the reserves managed, which we think is incredibly important. And there needs to be a lot more work around what are the standards and best practices for reserve management. How do redemptions, work? What are compliance programs? And then what blockchains does it run over? And I think this is one of the really interesting things that we've seen with stablecoins where you can have a single stablecoin like USDC that can run across half a dozen or more different blockchains. And so we find that that provides a lot of flexibility where there are developers who are building on Solana or building on Ethereum or building on Algorand. And it's really hard to pick one network and to say, here's the one network that all payment use cases will ever run over. And so being able to have a stablecoin that has, you know, good standards, good reserve management, but is available across, you know, multiple networks, we think is really important. And then there's, where is there support from an infrastructure perspective, particularly with things like custody? You know, if you want to be able to accept a stablecoin, you want to be able to make a payment in a stablecoin, you need a custodian that is trusted, that is secure, that can support that stablecoin. And so we think, you know, there are a number of different pieces of criteria that we look at, and we're excited to see that, you know, there's a lot of innovation and experimentation in the space, but it really starts with where are their use cases, where's their demand, and then doing that evaluation and starting really small with tests and pilots around just what does it mean to accept a digital form of fiat? You know, how is that different than existing fiat? And so that's been our approach, is that, you know, we want to get involved and we want to learn. And we believe that the infrastructure and the experience and the products that we build, you know, for one stablecoin are going to apply to other stablecoins and could apply to CBDC in the future. And we think there's a lot that central banks can learn and observe from the use cases and the properties that stablecoins have today.
Mm-hmm. And if I could, just one very, very brief intervention, because I think Kai raises a super important point about the openness. The openness of these systems is the feature, not a bug. And there are a lot of stablecoin projects, frankly, that end up looking a lot like monetary airline miles. They're usable, but only if you want to fly on a closed network. And the premise of this, as Rune, I think, just outlined a moment ago, is to compete for the open internet of value. And the way you do that is you remain somewhat technology agnostic as well. And I think USDC being available across multiple public blockchains enhances competition, enhances interoperability, but yet preserves the fundamental economic trust in USDC.
Yeah, that definitely makes sense. I'm wondering, Sonia, if you have any experience also. I know you're talking to a lot of global regulators and policy stakeholders. I know that you're advising them on how to integrate financial innovation into their banking and financial system. I'm wondering if you could share any experience on how maybe global policy stakeholders, central banks, regulators are approaching this topic of stablecoins. Would you say that they look at stablecoins the same way, such as a private company like Visa is looking into stablecoins? Do they see them as a potential threat to their monetary sovereignty? What is your experience talking to them?
Yes, I definitely think it's more the latter. There's a need to or the notion to better understand and regulate the space, because for policymakers, what is definitely creating a headache is the monetary sovereignty aspect that you just raised. The ability to sort of maintain control over the money supply, and the ability to control the money supply is important to apply monetary policy tools, and this is critical for countries in crisis times where you have to intervene to ensure that, you know, there's price stability in the economy, that consumers are not affected, investors not affected to their disadvantage. So that is definitely something that, especially for global stable coins, the ones that have a global reach, is for a lot of the policymakers and regulators is problematic, and there is a need to sort of intervene there by regulating the space better. And I think the question of reserves, which Kai mentioned earlier, is a critical one in that regard. The composition of reserves and how is it ensured that consumers are protected? Like, I mean, it's not just enough to state in a report these are the composition of my reserves, but it's also important to know that these reserves actually exist. So one way that the IMF sort of thought about the synergy between stable coins and, you know, the centralized finance world is perhaps the idea of a synthetic CBDC where stable coins could park their reserves at their central banks of their jurisdiction, where the central bank would have sort of overview, better oversight of what the reserves are composed of. And then, of course, it's not in everyone's interest, but that is a way to kind of bridge a gap between ensuring consumer protection, financial stability, while at the same time allowing stablecoin issuers and providers to develop their use cases further and to ensure that this innovative aspect of the space doesn't get lost or disregarded.
Mm. Is there anyone that wants to elaborate on that? So what do you think about this kind of initiatives like a synthetic CBDC? How do you think governments, central banks, and maybe stablecoin issuers like Circle and the Center Consortium or also MakerDAO could work together in this field?
Yeah. No, I'd be happy to. And as you know very well, obviously, I've spent an enormous amount of time on the front lines of not only the debate from an abstract point of view and how central banks and regulators view the innovation and the advent of stablecoins, but also clearly at Circle, being an operating company and the principal issuer of USDC, there are a couple of big first principles from a design point of view that you have to get right. The first is, where is the money, right? I think this big question has been an issue lately in the media, but also just in terms of regulatory engagement. Here in the United States, the President's Working Group on Financial Markets has been convened to look at this very question. And frankly, no central bank wants a stablecoin referencing their currency that is offshore and out of reach. So at our organization, the totality of dollar reserves supporting USDC are inside the care, custody, and control of the US regulated financial system. And then you could envision over time, very much to Sonia's point, that in a world in which there's equal access to the risk-free rate from central banks to the banking system or payment systems providers, then direct custody of stablecoin reserves could be organized inside the central bank itself. I don't think that's a breakthrough innovation, but I do think it's one of the really, really important air gaps that you have to preserve between central banks and the two-tiered banking system and payment systems operators and infrastructures. And we often forget that when we talk about CBDC, the technology stack supporting central bank digital currencies is not standing still. And governments around the world don't have a particularly high scorecard when it comes to digital transformation. And I think when you think of it that way, private sector innovation carrying the breakthrough innovation on how to move money on the internet is the right model. It's also a model that preserves privacy and preserves compliance, and I think, frankly, also improves compliance standards.
Mm. Yeah, is there any other view on this topic? Maybe Runo or Kai around the topic of also stablecoin regulation. Should they be regulated similar to money market funds? Should they be regulated similar to e-money? What are your views on this topic?
I was just going to add to Dante's point about how the pace of innovation happening in the underlying payment rails in the technology stack that are public blockchains is really, really important to recognize. And it also speaks to the innovation in the applications, in the use cases that are built on top of it. And so one of my favorite examples to give people is, in 2021, some of the fastest growing marketplaces in the world sell NFTs. They sell crypto basketball cards or JPEGs of pictures of animals that people are using as their profile pictures on social media. Who would have predicted that a year ago or 2 years ago? We can't imagine the future digital commerce use cases that will emerge even next year. And so that's where I think too often the conversation around CBDC is backward looking around how can we support use cases like a consumer buying their coffee in brick and mortar, rather than forward looking saying, how can we support a use case of someone in the metaverse with a VR headset playing a game that is now their income? And there are just these fascinating worlds that are emerging. And we think that open source and public blockchain technology is moving at a speed that the private sector alone and the public sector alone cannot move at, which is why it's really important to have these public and private sector partnerships to harness the innovation, to learn about the use cases, but then make sure that there are guardrails, that there's consumer protection, And that's, a lot better place to focus than trying to compete on the underlying payment rails, which are increasingly open source.
Yeah, I think it's definitely a tough challenge with regards to the pace of innovation in stablecoins in the crypto market. For regulators also to tap into the market and to find fitting models to regulate and to find policy frameworks around that. Rune, if you had any wish for stablecoin regulation, say in the European Union or in the US, what are some kind of key principles, approaches from the part of the regulatory and policy bodies that you would highly welcome?
Yeah, if it's about what's going to actually be best, I mean, then I have a whole wish list, obviously, that and for sure there's going to be the US or Europe or both. They're likely to overregulate in some form or another, which is just how it works ultimately. But I think the most important thing is actually this whole, when it comes to one of the really important things to think about is that it's really about, and it's a point that's already being made, right? That it's about supporting this open innovation that's already happening, right? So CBDCs, if they could be used by the Maker protocol to actually stabilize its decentralized stablecoin and sort of interact and get liquidity or get stability, that would be, a real sort of game changer, right? Because not only is that going to make decentralized stablecoins more safe and secure, but it's also going to attract a lot of innovation, because then suddenly the decentralized stablecoins, they'll want to be close to the economy and the central banks that actually is that forward thinking and sort of that much up to speed with where the future is heading. The other thing is basically to please don't ban decentralized stablecoins, because unfortunately right now a lot of the ways that regulators are considering stablecoins is they don't fully understand what they're regulating, basically. And so quite often what happens is actually with some of the proposed legislation that gets put out there is they accidentally ban Maker, for instance. That sometimes happens. That's just like a draft of like, this is how we think about regulating it. And then it creates a set of regulatory requirements that are fundamentally impossible for decentralized stablecoins to follow. And then, of course, the way that a decentralized stablecoin reacts to that is they're just sort of designed around the idea that governments may accidentally ban them, basically, and they need to be able to handle that. But of course, the much better option is this, the taking the road of supporting innovation. And ultimately, it's going to be almost like an evolutionary process, right? Where some jurisdictions are going to get it right initially, and others are going to get it wrong. And many are just going to not really take a stance at all. And then you're going to see value accrue to the economies that are able to properly sort of grasp these opportunities, which will then over time eventually sort of flip over the whole world, right, to the reality of the new paradigm.
Mm. Yeah, talking about different jurisdictions, we're here at the Digital Euro Summit, and what I personally find quite astonishing is that the whole stablecoin market currently is basically denominated in US dollars. And there's almost no single significant euro-denominated stablecoin on the market. I'm just wondering if there's anyone here in the panel that can elaborate on why that is and how we could change that in Europe, because I think we all agree that a euro-denominated stablecoin would be beneficial for the European economy, especially looking into the future.
Yeah, if I could, just because I wanted to build on 2 points. One, the point that Rune mentioned, I think it's really, really essential for the well-run, well-regulated crypto industry to start pushing back at the argument that the industry is not well-regulated. I think not only are we incredibly well-regulated, comparably, Circle as a company, we're comparably regulated to some of the world's leading payments companies. We're actually at a juncture of being able to import into the traditional banking system a lot of the good habits inherited from this novel industry. Where in the world can you track and trace illicit money flows down to a micropayment, but for public blockchains? This is a space that can make exponential gains on national security, economic competitiveness, more accessible payments, financial inclusion. The other piece of the puzzle is that there's an auditing, transparency, and accountability to way at least our company is run that would put, in fairness, many payments companies to shame. We have been issuing attestations as proof of reserve since the very beginning, since the first USDC was issued. We have similarly shifted the full composition of reserves to cash and short-term treasuries. And the last point I would make, and this is important for the digital euro question, Europe has very clear guidelines, as does the United States and as many other jurisdictions do too, about the pre-existence of e-money, right? If you want to launch a digital token that is used for payments and everyday payments in Europe, you have to first reconcile with the pre-existing rules around e-money and money transmission. We've done that in the US with state money transmission requirements, and a digital euro coming from Circle, for example, would reconcile e-money as one of the key pillars first. Now, I know obviously you have the markets and crypto assets framework coming soon, in no small measure to stop big tech from entering the global payments environment, but we think there are rules, and there are very well run companies in the crypto space that can compete in those rules happily.
Mm.
If I may just add to
Sure.
your question about why not euro-denominated stablecoins, I think it has something to do with the international role of the dollar. Perhaps it's more widely used in trade and commerce and invoicing around the world than the euro. But I really hope that the digital euro experiment or the research phase that has been launched, it will last for the next 2 years, will kind of spur this innovative thinking. I know that people might disagree because they're like, wait a minute, how will a public sector institution like the ECB actually, provide an impetus for stablecoin issuers? But I do think there's some potential there, because it's certainly in the interest of the ECB to see innovation growing and thriving, like on top of this digital euro backbone. So I do think that there might be potential for euro-denominated stablecoins coming on board once there's a clear decision, like, yes, a digital euro will be launched after this investigative phase. So I do think that might actually happen. We will see that in the medium to long term.
Yeah, definitely. And I also think, to come back to Dante's point, once the markets and crypto assets regulation is basically agreed upon and officially launched, I think, we will definitely see some euro-denominated stablecoin projects in the EU. Unfortunately, I already have to come to an end here. We covered a lot of ground. We really digged into the topic of stablecoins. Thank you very much to all of you, to Sonja, to Kai, to Rune, and to Dante. I think the key essence here, there is no race or no battle for mainstream adoption. I think there's a lot of room for collaboration between CBDCs and stablecoins. And I hope to see you back again in the near future and talk about recent developments.
Thanks, Patrick. Bye-bye, everyone.
Bye-bye. So next up in the agenda is a fireside chat titled How Traditional Finance and Decentralized Finance Simply Become Finance. So we will make things even more complex now by bringing decentralized finance into the equation to discuss how decentralized finance relates to central bank digital currency or to central bank digital innovation in general. And I'm honored that we're joined today by Joseph Lubin, who's the founder and CEO of Consensus and a co-founder of Ethereum. I think he's someone that needs no further introduction in our industry. And we're also joined by Carolyn Luke, who is an economy reporter from Bloomberg and has covered the topic of digital currencies extensively. So thanks to both of you for being here today, and I'm very much looking forward to your fireside chat. Carolyn, over to you.
Hi, Patrick, and hi, Joe. It's great to have a chance to speak with you here today. And I'd like to kick this conversation off with, a more broad question, since a lot of the listeners will have been, hearing about the digital euro and various central bank-led initiatives today. And you're obviously from the other side, from the decentralized finance side. So I'd like to hear from you, what do you think the coexistence of central bank digital currencies and cryptos will look like in the next 10, 15 years? And how do you think that will affect the average experience of, a consumer with money?
Well, I think it's unfair to say first that I'm from the other side, because at Consensus, we've operated under what we call the convergence thesis since our start, where we realize there's a profound innovation in decentralized protocols and blockchain technology. And we, along with others in our ecosystem, have worked to build out the technology. I built a new decentralized trust foundation for the planet, which has enabled decentralized finance, which will enable so many things to get built on top of sounder trust foundations. And we work with multiple central banks currently and over the years, in addition to building out lots of the infrastructure for the Ethereum ecosystem. Given that background, we're very excited for the coexistence and interoperation of central bank digital currencies and the more public mainnet implementations of financial instruments and financial flows. We certainly are excited about CBDCs. They're an essential evolution in money and in the construction of financial instruments. Blockchain technology has brought forth the invention of digital scarcity. It's enabled trustworthy collaboration and transparency amongst actors with different agendas, competing and cooperating with one another. And it is leading to profound tokenization of so many things in the new digital economy, but also digital twins and other things in the more traditional economy. And so that brings so many benefits: clearing and settlement in the instant of the transaction, real-time risk metrics, sensitivity analyses, accounting, real-time GDP measurement, automated compliance checking, and payments of taxes, and potentially something like closer to real-time monetary policy. So those are the benefits of the technology. What I would like to see is not for central banks to focus on standing up next generation technology networks that just support the tokenization of money, but realizing that that tokenization will serve as a foundation for the emerging decentralized, increasingly decentralized digital global economy, and that these networks need to be sufficiently capable, sufficiently expressive, sufficiently scalable. It's something that we're going to need to work on together for years to come, so that the emerging economy will be built on top of these networks, whether they are central bank run networks or more public networks. We need interoperation of these systems. The increasingly decentralized web will be composed of, in part, decentralized protocols that interoperate with one another, similar to how many different kinds of databases provide the backends to lots of different applications. So you've got SQL databases and non-SQL databases and graph databases, and we're seeing that with different blockchain architectures and different decentralized protocols. And so all of these things need to interoperate with one another in order to unlock all of the potential.
Yeah, and I think that's really interesting. And speaking specifically on this point of integration and networks, I'm aware that you're very much working in that area, and I'd like to know more about what you think about whether we could see a situation where CBDCs are eventually integrated into decentralized finance applications, and how that might work. And a second question I'd have for you is, I spend a lot of my time watching central banks, and a lot of the commentary I've heard in that community lately has been around the technology that CBDCs could run on, and you were touching on that just now a little bit yourself. And we had the former head of the digital currency project at the PBOC recently say that he could see, CBDCs becoming more smart eventually and operating on networks like Ethereum. And at the same time, we had a report by the ECB which suggested a more hybrid system, but it also raised concerns about, the digital footprint of a blockchain-based solution. So maybe you could talk about those 2 points. First of all, the integration of decentralized finance with CBDC, and second of all, what you see for the future of like CBDC networks.
Yeah, so it's a profound technology, and we need to have lots of discussions over the next months and years about how different nation states want to situate, embrace this technology according to their different political and economic philosophies. It is likely that decentralized finance, and we're already seeing it, will move towards accommodating the current rules of different nation states. So Compound and Aave and others are figuring out how to apply current regulation so that regulated actors can participate in their lending, borrowing infrastructures. And it is likely that that increased, hopefully lightweight regulation can be applied to the ecosystem, recognizing that forcing every actor, including smart contracts, to report on every other actor is incompatible with the technology, but also recognizing that a lot of regulation is present to protect the consumer from those who custody their assets, and in a technology that enables consumers to custody their own assets, or enables certain checks that make it essentially impossible to be out of compliance or to steal funds in different ways. We can, I think, going forward, have a discussion amongst the technologists and the regulators, the lawmakers, about how to think through future regulation, hopefully lighter weight regulation. Some of the footprint issues that you're referencing, and hybrid architectures, I think that relates to the proof of work system that is heavily consumptive of energy. And I agree that proof of work is what was a great first pass at building consensus-based systems. Proof of work is also an excellent mechanism for fairly distributing tokens in these public systems. Proof of stake, however, is a much more efficient, much more decentralizable mechanism. It'll enable transactions to be much cheaper. And the energy footprint of proof of stake systems, which Ethereum is moving to towards the end of this year and the start of next year, will be 99.9% much more energy efficient. So Ethereum has the benefit of having used proof of work to distribute the token very broadly, which is an issue for proof of stake systems, because you've got some group who are distributing those tokens, and proof of work ultimately ends up being a liability, in my opinion. Let me leave it there.
Okay, yeah. Maybe we can take a bit more of a general view for a moment and talk about how you see decentralized finance changing the traditional financial sector that we know. So, about how you see them converging and which developments are likely to stick around as we go forward.
So The internet and web technologies democratized access to information, the ability to publish information, set up and participate in e-commerce and social networks. So a profound global shift in how we all operate. And with respect to the trust layer of the planet and with respect to the financial layer of the planet, we're seeing the same sort of opening, open source based democratization of essentially governance of the lower layers of the planet and at upper layers as these systems begin to be governed via decentralized organizations. And we're seeing entrepreneurs and technologists get in there and build and tweak and fix and iterate in a way that is enormously creative and will drive tremendous innovation, much more innovation than what we've seen previously. Obviously, things just move really fast in the world of technology, and so trust is going to evolve on this planet. Different governance systems will be tried in our ecosystem and will hopefully be used in more traditional contexts, and especially decentralized finance constructs, the ability to create a protocol that's shared by everybody, the ability for many different actors to create interfaces to that protocol, that shared protocol that's published out in the open on mainnet, the ability to wire up these protocols, money Legos as they're described, into creative and complex flows, and the transparency, the ability to create a financial system on which you can stack lots of different kinds of value flows, lots of different kinds of yields. And if you get into trouble, the whole thing unwinds in real time. You can have, and we've had significant losses of value in our very young, relatively small ecosystem. But it just works. You don't need a plunge protection team or massive bailouts in order to keep the decentralized economy going, because you don't get massive imbalances built up over years or decades that need unwinding, and you don't get lots of assets obfuscated or just difficult to track down. It's all there out in the open.
So, but that being the case, what do you think is holding back decentralized finance at the moment from becoming, more mass market and more mainstream? Is it a regulatory issue? Is it institutional? What's your take on that?
So it's partly regulatory. Institutions are coming. Massive multi-asset funds are looking for ways to deploy capital into the space. There's the realization that that money systems are potentially end-of-lifing. That money is depreciating. Nation-state money is depreciating in value and not yielding. And this new decentralized ecosystem is growing and represents the future, and the money in this ecosystem is appreciating in value, and there's demand for it, and so the yields are significant. So we have, what's slowing it down is the technology itself. Essentially, it is insufficiently mature to handle all the world's use cases at all, let alone economically. And so we see on the Ethereum platform, the most decentralized, most expressive of the blockchain systems, we see high transaction fees, and we see lots of systems, side chains, and layer 2 systems sprouting up to offer a lot more transaction throughput and much less expensive transactions. And that's wonderful, because Ethereum mainnet can support certain kinds of use cases that are economically viable at a transaction price that is relatively high. And as we get more and more transactional throughput across the ecosystem and all these networks interoperate with one another, we're going to get more and more use cases that are economically viable. And so as the technology matures, the cost of transactions and the number of transactions per second will increase to support more and more of the emerging global economy and enable elements from the legacy economy to move over onto these more efficient rails. But it will take time, years, possibly decades before the infrastructure is mature enough to support a global economy.
Yeah, and you mentioned regulation briefly earlier, and I wanted to delve a bit back more into that. Just in terms of, how do you think that regulators are looking at decentralized finance at the moment, and what solutions do you see for regulating it at all, if it's possible, and how's that going to play out in the next few years?
So I think some regulators are looking at it in amazement because there are a lot of very powerful concepts and constructs there. Depending on who you are, if you're a securities regulator or if you're concerned with the flows of value from one actor to another, you'll have different perspectives. From the perspective of securities, would be great to get more regulatory clarity out of the authorities. But in the U.S., I do think that that the SEC has come to a sophisticated understanding of the token technology and has been doing reasonable things. I think in the end, when we understand their arguments, we will follow hopefully what they're thinking. In other nations around the world, there has been greater clarity and greater embracing of the technology. With respect to regulating the flows of value, it's going to be very interesting. I think lightweight regulation of the technology, including using the technology itself. So compliance can be built into smart contracts and checks can be built into the software. I favor a situation where we have a public permissionless base level infrastructure. This is something that I believe nation states are going to increasingly need to mediate some of their transactions. For instance, treaties could be constructed and guaranteed by financial bond on blockchains, and punishments can be economic. Generally, treaties are difficult to enforce when they're just written on paper, and nation states just choose to disregard promises they've made. And so with that sort of base permissionless foundation, I think we can build layers of infrastructure that service consumers and other kinds of actors that really do need handholding and do need protection from certain risks in the economy.
Great, thank you. I think we wanted to maybe give a chance to take some questions from the audience, but I'm not sure if there's still time for that.
Unfortunately, we're running out of time. I don't want to interrupt you since it's a very insightful discussion, but be assured we will follow up on many issues raised in your fireside chat in the following panel. But thanks a lot, Carolyn. Thanks a lot, Joseph, for your insights.
Thanks, Carol. Have a good one.
All right, as mentioned, we will try to follow up and dig deeper into some of the complexities of DeFi in the following panel, the last panel of today's Digital Euro Summit, which is titled How Decentralized and Disintermediated Will the Future of Finance Look Like? And in order to shed some light on these questions, I'm really honored to be joined by three absolute experts. Here with me are Sheila Warren, who is the head of blockchain and digital assets at the World Economic Forum. We have Stani Kulichov here with us, who's the founder and CEO of Aave, one of the most known and the most successful DeFi projects out there, and also Björn Wagner, who's the Chief Commercial Officer of Parity, the company behind Polkadot and some other famous and interesting projects. Great to have you here with us. I would suggest to directly jump into the topic, and let's maybe start with the most basic of all questions regarding DeFi. What exactly are we talking about when we talk about decentralized finance, and what are its main benefits? Maybe Stani, do you want to jump in and kick this off?
Yeah, thanks for having me here. So just to kind of like give a brief overview, what is DeFi? So I mean, short for decentralized finance, and pretty much it means that you have a kind of like a financial ecosystem that is inclusive to everyone, so everyone can participate without a permission, and not just participate by using these different kind of protocols, but also without a permission to build new kind of like protocols and products on top of the existing infrastructure, and also in a way that is transparent, and you don't give a custody of your funds. And essentially also you're, as a user, governing those protocols and building together with the community. So it's kind of like a new way of accessing finance where you don't rely on centralized kind of like a gatekeeper service provider necessarily, but you have like a finance as a human right in a way that you are able to access various different protocols, and developers across the world can actually build new innovation on top of this infrastructure. And the more you use these protocols, you become more of an owner of the protocol. Imagine if you take every time you deposit funds into a bank account or take a ride of Uber, you get more equity of those companies. But here you are actually like getting more stake of a protocol that is used across globally in a borderless fashion. That's pretty much like what I think DeFi is, at least for me.
Yeah, makes sense. So open access, decentralized governance, distributed ownership, and also basically the open composability of the networks are some of the keywords in order to understand DeFi. Is there anything, Sheila or Björn, that you want to add to the basic definition or understanding of DeFi?
Sure, I summarize it as, you know, it kicked off with kind of the understanding that we now had programmable smart contracts, and then what can you take from there? And so basically the concept of having a system that's got economic reward, as Stani mentioned, programmability and decentralized governance, I think are the innovations that are kind of the foundation for DeFi. But it's really just a suite of services, of financial services, some that mirror existing financial services that exist in CeFi, but others that are new, that are going to be brand new. And we're just, I think, starting to see some of those kinds of opportunities emerge. But I really liked what Stani said about, you know, finance as a human right. The idea here is that we can open up a lot more access. We can deal with some of the issues that have happened around inclusion or historical exclusion of certain kinds of people or communities or whatever it might be, either because they were engaging in too small a value transfer or exchange, or because they were redlined out because of some kind of de-risking or whatever might have happened in the systems. And so that's something that I think I'm most excited about. That basically, yeah, I think that it's leveraging a lot of what has been so exciting about crypto more generally, about smart contracts, and really driving forward a whole new suite of opportunities with the goal in mind that they will be truly global in nature and accessible to every single human on the planet, regardless of where they live, who they are, and what their specific goals might be.
Mm-hmm. And maybe on top of that, and Björn, maybe you could shed some light on that. Where are we right now in terms of market adoption, in terms of market maturity in decentralized finance? What are these decentralized financial services that we're talking about? What are those services currently used for, and by whom? So could you give us some kind of state of the art? Where are we right now in DeFi?
Sure, I'd be happy to. But I think overall, I would say we are quite early in terms of market maturity. The technology is sort of there, getting better every day for sure, but there's still a lot of work to be done across the industry, market participants working together to form the principles and mature this further, right? I think if we look at the current state, currently it is really the creators, the geeks, the early market participants that are the primary users of these applications and protocols. But I think we are seeing that change with a lot of forward-looking industry players and regulators approaching us to make sense of the opportunities and challenges with these new technologies, really. And I think going back to, what is DeFi and kind of what benefits it brings, like for some part of the audience, it might be interesting to look at it in context of what we have today, right, in terms of financial market infrastructure. And like DeFi is definitely like a broad and catchy term that encompasses a set of tools, framework, principles, applications, and so forth, right? And definitely ambitions to, I think what Sheila and Stani laid out is kind of like an open global financial system built for the internet age, right? And if we look at the current status, right, like in the case of the EU, for example, there is already a supranational payment system, right, which is to some extent distributed and not fully centralized, right? But overall, this is a clear exception to the rule that I would say all developed countries have one or more, of these payment, clearing, settlement systems for both cash and securities. But I guess the majority of these systems, right, were set up and created heavy intermediation due to, in part, of technological limitations of the 1970s. And that I find quite interesting when we look at the stuff, right? Because if you look at central security depositories, right, CDCs such as DTCC, right, and even exchange operators today exist the way they do, partly because of an era in which like we only had mainframes and mini computers, right? Like we didn't have the tools to create anything else. And I guess the use of this financial market infrastructure, right, has often, though not always, resulted in efficient processes which support very high transaction volume and the exchange of very large transactions, what we really need to facilitate our economies, right? But therefore, like these intermediated assets that came out of that had like two critical side effects. Number one, creating a pattern of intermediation that is highly tiered and concentrated. And second, creating intermediary exposure that can amplify systemic risk in the event of an intermediary's failure. So, and if you look at all of that, I believe with like 40 and 50 years of serving us, this infrastructure, we really got to think about, like, isn't there a different way? And what if we could safely or securely disintermediate these market structures, reduce single points of like trust and failure, remove these monopoly rents that we see today, and all while potentially following a similar or more evolved principle. And I think that's really where DeFi comes into play, right? That as a bold vision to tackle that.
Yeah, definitely. So maybe if I try to summarize your point, it's basically there's a very bold and far-reaching goal for DeFi to becoming basically a new global and open infrastructure layer for financial services. But if we look at the reality right now on the ground, basically it's still quite early. It's still a system and it's still an infrastructure technology used by technological enthusiasts, crypto people, built by crypto people. So my next question would basically be, what needs to happen in order to change that? So what are still the biggest barriers for mass market adoption with those decentralized financial services? Is it regulation? Is it the technology itself? Is it just an education problem? I'm sure, Sheila, you have a good overview on what is still missing.
Well, I certainly have a point of view, and I agree completely with Bjorn that this is so far relegated to the realm of, high finance, right? So people who already kind of understand and have been engaging in pretty sophisticated kinds of transactions already are now kind of taking that knowledge over to the DeFi ecosystem. And that seems to me like a perfectly fine place to start. I mean, I think that is reasonable and makes sense. But there are an awful lot of people who need far more basic services, I would say, that aren't necessarily about sophisticated arbitrage opportunities or even creating kind of new forms of credit. They're just people who need to operate it. Again, these very, very small dollar amounts, let's call them, or whatever currency they might be or traditionally using, are not able to use. I don't think it's a regulation problem, because a lot of these kinds of communities are already sort of below the threshold where regulation really kicks in. So we're not talking about a place that is already heavily regulated, although it is in some cases. We are talking about markets or communities that have had a really hard time. And part of the reason they are not already included in the existing financial system is because they are considered riskier for whatever reason, or because the ROI for a bank or whatever to engage with them is just not present. So if you're talking about like the remittance economy comes up all the time, that's kind of a bit of a staid example in my opinion, but there are a lot of other places where people simply can't get access to just a basic credit line because they don't meet the requirements that any sort of credit lender has in place, again, because of these kinds of perceptions that they're a riskier community or a riskier person or individual to engage with. So I think there's a lot to be done there. And I don't really see regulation as being the barrier in those particular cases, but certainly it's a barrier in many other cases where, there is this sense of how do we deal with the kind of, CTF, counterterrorism financing kinds of measures? How do we kind of deal with KYC, AML identity questions? Like some of these things I think are interesting. Right now, a lot of that is being relegated to on-ramps and off-ramps, which is, again, appropriate and not surprising because we're still quite early in this space. But at some point, we are going to have to kind of wrestle with what that means. And I think we're seeing some of that happening now through, measures that certain regulators are taking to kind of get more information. At least that's maybe the most positive way of thinking about what they're trying to do, is gain more information about what's happening in the ecosystem.
Yeah, I think that's undeniable that regulators and policy stakeholders are starting to look closely at the DeFi market. I'd like to double down on the same question and have your opinion, Stani, as well on the topic. What is still missing for the mass market and for institutional investors as well to tap into the market? I know that you are launching an Aave, basically an Aave institutional money market as well. Could you walk us through the reasons why you thought that would be necessary and why you thought it would be necessary to create a separate platform, and what, in your opinion, will be really a key game changer for DeFi in the adoption cycle?
Yeah, I mean, first of all, I've seen like the whole DeFi adoption until this point has been like very remarkable. I mean, it's just like amazes me how much like innovation there is, and this innovation drives more and more drive for capital into the space, whether in form of like investment into startups itself that are building these new products and protocols, or directly like capital allocation in into the protocol itself. And what amazes me is that in some sort of way, DeFi is kind of like a marketplace of liquidity and algorithms. As long as there's some sort of inefficiency or innovation to be built, what happens is that we see new innovation coming and capital getting allocated between protocols, and more opportunity for new capital to come in as kind of like there's more demand, as there's more and more bigger ecosystem. And what we noticed that kind of like there is institutions now in decentralized finance that are actively using these protocols, which is fascinating. But also at the same time, we kind of noticed that there's a lot of kind of like unclarity or like a higher risk appetites for some parts of the institutional sectors in finance that actually want to participate into decentralized finance, and they want to kind of like get more involved, but they just need a kind of like a more segregated, more private environment, but still use smart contracts for execution, use transparency, the public Ethereum blockchain to see all the activity and what's happening in the markets. So for this kind of like a demand, what we have been working is this Aave Arc market, and the Aave Arc market is a segregated market from the Aave markets and DeFi in the traditional sense we have seen, where there's so-called whitelister, which can be a custodian, it can be a bank, it can be any kind of like an institution that has customers, institutional customers. And that whitelister can actually whitelist addresses to deposit, borrow, liquidate on that particular market, meaning that you can actually create additional requirements how you can join the market itself. And that means that you can create higher risk, a market for higher risk appetite, and that way you create an environment where institutions can participate in decentralized finance with counterparties they might know a bit more better than in completely open permissionless system. And I think like the whole future of DeFi will be always permissionless, because that's the kind of like idea of having decentralized finance, bringing people like finance as a human right, but also institutions this kind of like ability not to rely too much of service providers, but has accessibility. But at the same time, we see that to speed up the process, we kind of need to go both ways at the same time. And this is something that's going to be launched by Fireblocks quite soon. And it's interesting because it's a market that we have been working with Fireblocks and Galaxy Digital, and it will be governed by the Aave governance. So the Aave governance will practically sell the risk parameters to that market, and the whitelister will then choose what kind of like a counterparties can join that particular market. And you can create multiple of Aave markets, so some might have even more additional or different kinds of requirements. So I'm very curious to see like how that adoption goes. And of course, the Aave protocol itself has been integrated to many like custodians at the moment, and more fintechs are looking into how they can plug into DeFi. And there is kind of like why these custodians are very important role of plugging in more mainstream users into the ecosystem. But most excited I'm about tools that make the user experience for normal users. It makes DeFi and the whole Web3 more accessible, building better wallets, building better user experiences, and educating people why you could have actually direct connections with decentralized protocols and Web3, and why it's more important than choosing right away, giving up custody of your, let's say, finance and your kind of like Web3 interactions.
Yeah, curious to see how the whole approach of creating different basically protocols and money markets also for institutionals, how this will play out. Björn, maybe would you agree with this approach that institutional investors, maybe the mass market, needs really some specific approaches, that you need to create basically different products and services for different kinds of markets? How's Parity, but especially the Polkadot ecosystem, how are you positioning yourself to have a role to play in the future of DeFi? And how are you trying basically to attract more and more users, more and more institutional investors into your DeFi ecosystem within Polkadot primarily?
Right, there's a lot in there.
Yeah,
I think I gotta unpack that a little bit. So, right, so I think we're talking generally about potentially two different things here, right? Like on one hand, we're talking a little bit about mass market adoption by average users, right? And I think Stanley made a fantastic point of like, these sort of things aren't particularly accessible today for the average Joe, right? You have lots of foot guns lying around left and right that you can really hurt yourself with if you do it wrongly. So there's still a long way to go until we have the user experience, the infrastructure in place for people to safely and confidently interact with these sort of applications or services built on top of the infrastructure, right? And now coming a little bit more to what my purview is, or what our purview is, which is the platform, the infrastructure that DeFi applications or other sort of applications, not just DeFi, is built up, right? And so my company, our project comes from the Ethereum space. We've been, my co-founder was one of the founders of Ethereum. Like we built a lot of the stuff. And as the years went by, we noticed that the technology wasn't mature enough yet to actually be a breeding ground, a delivery bed for all these visions and like that people had out there, be it for DeFi applications, supply chain applications, or whatsoever, right? Different protocols. And so as we went along, we saw at some point almost like a Cambrian explosion of folks building alternative infrastructures to existing blockchain platforms such as Bitcoin and Ethereum. And people went and built their own blockchain platforms that were specialized for specific use cases, right? Or that enabled those people that wanted to build in a specific industry to do it so better. But the problem with that is that eventually, if people end up doing that, you end up with similar issues that you see us having today with existing infrastructure where you are siloed into that platform that you've built upon, and you lose most of the benefit that you want from blockchain, right? Where you can't actually have open APIs and access to data that's on another platform, right? You end up in a walled garden again, right? And so that's where we really came in with the idea and the vision of Polkadot, where we said like, hey, we all share a certain need for having a secure platform that's not too opinionated, that enables people to build, to optimize their applications for a specific use case, and enable them to benefit from the network effects that you really want by being part of the same platform. And that's where we set out to build Polkadot, which is really a kind of an interoperable meta blockchain, so to say, right, that provides these connected pieces with security and the ability to speak and interoperate with each other. Yeah.
Yeah, I was just going to chime in on something that you alluded to, Bjorn, which is, this idea that more broadly speaking, if we're not careful, we are going to wind up replicating certain kinds of challenges that exist in the current system. Chief among them is this kind of ability to interoperability, interoperate, to take your toys and go somewhere else if you want to, or to kind of be very fluid in how you're operating within this new system. And this is one of the reasons I've been concerned about what I see as premature regulation, because I do think that many regulators, despite even the best intentions, comment things, understanding them as they mirror or they seem to be similar to things that already exist. And to the extent that we try to force any new innovative space into models of regulation that have previously existed, we really risk forcing those new innovations to mirror other things, even if they didn't necessarily inevitably have to. And so I do feel it's a big concern that these are symbiotic things. So as regulation comes down, there's kind of a scramble. And you see this in other systems, right? There's just kind of a forcing function almost, that you have to start replicating certain kinds of things that came before in order to comply with what the requirements are. And so I think one thing I think it's just so important to understand is, again, like, even though there's been a lot of traction in this space, it's blown up. The Cambrian explosion is exactly right. It's still really early, and there are an awful lot of things about this space. They may, so far, seem to mirror things that have come before in terms of the kinds of services offered, et cetera. But that is not at all the end game. That's not inevitable. And I think that is based on a kind of a misguided or misunderstanding, basically, about not just what's actually happening, but the potential of this space. So this, I think, is the reason why you're seeing, well, it's part of the reason why you're seeing so much activity from the ecosystem around response to perceptions that regulation might come in and cut off the ability to innovate and result in a replication of some of the things that are the reason we want to innovate in the first place.
Mm. Yeah, maybe coming back to that point of regulation, Sheila, I know that you at the World Economic Forum, you published basically some kind of policy toolkit for DeFi, for regulators and stakeholders. I'm just wondering if you know any global policy approaches from some jurisdiction where you would personally say that goes into the right direction, and maybe other approaches where you would say that would be more harmful for the industry. Is there any best practices already around in the market?
I would say no, and that's the reason why we felt the need to put out the canvas that we put out within that system. Now, that toolkit we released was a result of a year of investigation into this space. So it started over a year ago because we knew this was going to be a space that was going to attract regulatory attention, regardless of what happened. It was just inevitable in that case. So we thought it was really important to put out there just a canvas that indicates, what are your goals as a regulator? What are you trying to accomplish? What is it you're worried about? What are you trying to accomplish? Have you really thought about whether the things you're worried about are real fears or whether they're more perceptions of a fear? And then how do you balance the things that you're trying to do? So we at the forum, we're not anti-regulation. As I said, regulation can be a forcing function. Sometimes that can be helpful, but sometimes it can be a problem. It just kind of depends on what happens. And so our view was trying to pull together a community that understood the direction of travel, that could kind of indicate, look, it's early to regulate something like this. We don't really know, all that. We have not in any way seen all the things that are going to happen. So here's some considerations. Here are some factors to weigh, which is how any good policy should be made. But it really is important to be cautious. So I would not say that I've seen a global approach that I think is a best practice. I think that what we've seen that's a best practice is caution, is trying to really get into the weeds and the details and understand the space. I commend, many regulators and legislators are doing that work, and I don't think they get enough credit for it. So I really commend those who are trying to understand and trying to learn, because it's not easy. And those that are sort of taking their time with it, understanding that there is a space that probably they're going to have to act at some point, but being very careful about what that action might look like and what the implications for it will be.
Yeah, for sure. I mean, that's something that also we as an industry association will try to cover as close as possible, especially in Germany. Since we're almost running out of time, I would like to ask one last question, which is basically the title of this panel discussion: how decentralized will the future of finance really look like? And I would love to have a very quick, like 20 or 30 seconds answer from all of you. Do you believe in a future where just every person will have a self-custody wallet and interact with decentralized protocols? Or do you think there are still some functions which have to be served also in a distant future, maybe in 10, 20 years, by financial intermediaries? Maybe let's start with Stani.
I think like what we will see is that the users will have a choice, so you can directly interact with different kinds of protocols, the same way as you can generate, let's say, Ethereum key and receive Ethereum, and I guess also you will be able to use these protocols indirectly through intermediaries, which is also nice. And I think there will be more and more competition of creating better user experience. And that's the idea of kind of decentralized finance, that when you have an open graph that anyone can build on top, it means that you put the front ends and all the intermediaries to compete on creating better services, because the users have always a direct access. So I think we'll see more adoption on actual direct access, but I will see a lot of DeFi will be offered behind the kind of a scenes to wider audience as well with fintechs.
Anything to add, Björn?
No, I think that summarizes pretty well. I also hope to see and believe we will see more freedom of choice primarily, right? It should be my choice to choose whether I want a custodian, if I want to use an intermediary that I trust, under my own terms to some extent, right? And that's really what I hope to see. But I do think there is still a place for intermediaries in some cases, for sure.
Yeah, and maybe last comment on that, Sheila?
I absolutely agree on freedom of choice. I think it's going to be very generationally driven. I think my children will be what I call crypto native. I think that my parents are going to want a custodian for the rest of their lives. So I think that as we see a shift and we have more and more crypto natives entering certain kinds of markets, coming into their own, entering the workforce or whatever it might be, we're going to see, I think, more pull towards this kind of thing. But I agree, it's going to be a freedom of choice situation for sure, which is what I think we all want to see.
Yeah, 100% agree on that. So unfortunately, we have to come to an end here. Thanks a lot, Sheila. Thanks a lot, Björn. Thanks a lot, Stani, for your insights. It was a very dynamic and insightful discussion. And I hope you will stick around for the closing keynote of our state secretary. So if you want, join the live stream link and hopefully see you soon.
Thank you so much.
Thank you.
Yeah, having already touched upon the topic of regulation and policy frameworks around those financial innovations, both central bank digital currencies, which we covered in the first half of our summit, and then also private sector financial innovations, especially around stablecoins, crypto, and DeFi, I'm now very pleased that our closing keynote will cover exactly that topic, policy and regulatory frameworks. I'm honored to welcome Dr. Jörg Kukies, who's the State Secretary in the German Federal Ministry of Finance. I think it's safe to say that Dr. Kukies is a supporter of financial innovation, both on the central bank side and also on the private sector side. So I'm honored. We are honored to have you here with us, Jörg Kukies, and we're very much looking forward to your closing keynote.
Excellent, thank you. After you've raised the bar now, I will have to make sure I satisfy the announcement. So I think for us, the issues of DLT technology, crypto assets are extremely important. We have, as a government, decided to embrace a blockchain strategy to document how seriously we take this issue, to make sure that we are at the forefront of the development of blockchain technology, and that we try to innovate, that we attract many startups and many companies into the space to use the potential for innovative change in the context of the increased usage of DLT, in the context of the next generation, as the previous speaker has said, growing up as crypto natives. I think it's extremely important that we embrace the change that goes along with that. We started out thinking hard about how we can marry the world of standard financial products, conventional financial products with DLT. One of the initiatives that we took starting at the beginning of the legislative period was a law on the introduction of electronic securities. We finalized the Electronic Securities Act, and we introduced a legal basis for the provision of crypto custody business through the German Banking Act. So in that sense, we acted at the national level. And of course, we are also quite keen to think European in our national legislation. We always thought about how those rules would fit into the European space. And of course, we are very active, and I'll get to that a bit later, to all of the debate and discussion and legislation around the regulation on markets for crypto assets. Mika. Together with that, we are also, and you mentioned that, from the beginning been a very strong supporters of the attempt to introduce central bank digital currency. We've always encouraged the European Central Bank to start the investigation phase, to be ambitious about the introduction of CBDC. And we therefore welcome the recent developments in July that the ECB has decided to continue the ongoing work, not making a decision yet, but launching into further exploration at a high ambition level and in great detail. So I think that is one pillar, and I'll get to the details of how we think about CBDC later. Another pillar of our strategy has, of course, been to foster the startup ecosystem, and venture capital has been a key component of that. We are absolutely convinced that we need more venture capital investing in Germany. We need a stronger presence of venture capital in our country. We want to encourage that. We've seen some very positive developments lately with the number of unicorns who are going through ambitious and high volume funding rounds substantially increasing, several going into the IPO stage. So I think the development in general is very, very positive. However, we still have quite a lot of work to do. One of the things that concerned us, of course, during the Corona crisis was the fear that we had early on in the stage of Corona crisis of funding rounds not materializing. We received quite a lot of incoming from startup companies who were fearing that financing rounds that were upcoming wouldn't materialize, A, due to the much more difficult economic situation given the lockdown, and B, the inability of VCs to travel. That was literally an argument that there was a fear that due diligence couldn't be conducted anymore. Now a lot of VCs and startups are telling us that actually the Zoom type of DD can be even more efficient than the physical presence DD. I think the truth is probably somewhere in the middle, and the equilibrium will probably be, as travel restrictions are lifted, some combination of virtual and physical due diligence meetings. The take up of the 2 billion fund that we then launched to basically match the financing rounds being done from the private sector with public funds to increase the size of those financing rounds greatly encouraged us. Out of the 2 billion, there have now been applications for 1.7 billion of volume, so virtually all of the money has been allocated and dedicated. So in that sense, I think it's been good to sort of build the bridge into a calmer market. It was front-loaded, as many of our fiscal measures during the crisis. The pickup at the beginning was strongest, and sort of as markets normalized, tapered out. However, what we're still seeing, and that encouraged us to go bigger and to think even more ambitiously with a 10 billion follow-up program, is that we're still seeing a lack of scale of venture capital and startup financing in our country. So we decided, together with the German Parliament, to set up a 10 billion future fund with the goal to raise more capital for the startup scene. In fact, we also want to continue the idea of partnering with private investors, whether it's angels, whether it's VCs, whether it's family offices, whether it's institutionals, to leverage the 10 billion that we're providing in terms of public funding into a target size of 30 to 40 billion over the course of the next few years. And we're going in a very large variety of ideas to spend that funding, whether it's our deep tech fund, whether it's the using our high tech founders fund and leveraging it into later financing rounds, whether it's increasing the scope and volume of our KfW capital programs. There's a very large number of ideas where we want to bundle the instruments to promote startup financing, increase the volume, but at the same time, and I think that's a very important element, always partner with private investors, because we certainly don't believe that any of us sitting in the ministries have the competence, the ability to figure out whether startup company A, B, or C should receive XYZ amount of funding at which term. So we're perfectly happy to co-invest, to invest pari passu. Our big goal is really to increase the size of the market with the instruments that we have. We also took two very substantial steps that quite a lot of the venture capital industry told us was impeding the growth of the German market. The abolition of the charge of value-added tax on management fees from venture capitalists has been persisting in Germany for many, many years. It has been a competitive disadvantage to the German market, and we have abolished that VAT charge on venture capital management fees. So that was a big move. The second big move that we made was one of the key deficiencies of our markets was the disadvantageous treatment of employee shares and employee options. We especially addressed the issue of dry income, where you would be immediately taxed upon allocation of employee shares or employee stock options with the full value of those instruments, which of course leads to a massive liquidity mismatch. We've addressed that problem. I'm fully aware that many of you, many in the crowd, would have liked to seen more and a more generous piece of legislation. But I think the bottom line is that after several decades of raising issues and the issue not being fixed, we finally came up with a piece of legislation. And of course, as always, we're committed to evaluating that as we learn from the practical experiences being made. And we will continue to take on board the feedback from all of you on our program. And of course, in the new legislature, the golden rule is that it's always easier to change an existing piece of legislation than to come up with a new one, i.e., we will now have a very specific piece of legislation that we can evaluate against the realities. And the goal is definitely to be very ambitious in this area and to look very constructively at the feedback coming from market participants. Going into a bit more detail of some of the rules that we've changed and some of the, in our view, innovations that we came up with in our legislation. We think that establishing a reliable framework and a trustworthy framework for innovative business models is important. At the same time, of course, making sure that our regulation doesn't set up new barriers to entry. So the crypto custody business that we set up in our German Banking Act is an attempt to go into that direction that received quite a lot of positive response. We have received more than a dozen applications from firms that are looking to go into the crypto custody business. We've already been able to license Coinbase as an operator with the new license. So in that sense, I think there's more to come on that, many more to come. And we're really hoping that with this piece of legislation, we've set up a standard for a combination of innovative legislation together with attracting a lot of players to our country. So in that sense, we really want to become a leading industry location for tech innovations, and this is a core part of our ambition. And also, I think it's important to note, if you look at MiCA and the framework it sets up for crypto custody, our legislation really is in line, and those who will get licenses under our framework will have a much easier time applying for the European license. So that's also something that should be considered. Another piece of legislation that we passed, as I said at the beginning, is the Electronic Securities Act. I think that's very, very important. It was highly complex, I have to say. Anyone who knows German law will appreciate how difficult it is to marry the innovative power of blockchain and DLT with the German civil code, with German securities law. But at the end, we got through just before the end of our legislative period with a piece of legislation that we think strikes the balance between, on the one side, investor and consumer protection, market integrity, and the functioning of capital markets with the innovative power of DLT. Anyone can still continue to issue securities in the good old-fashioned way. There's no, we're not forcing anyone onto DLT. However, the option is now there that in a technology neutral way, any issuer can choose between the two methods of either going through DLT or using the conventional way. There is the way to create central registries through a central depository to give access to the relevant and respective stock exchanges and regulated markets. The second option, and that will be the one of interest to most of you, is to have a crypto securities registry licensed under the German Banking Act. So it's a free optionality. This option of the crypto securities registry will be, of course, the one relevant for issuing electronic securities via DLT. However, as I said, we don't want to introduce any advantage to either technology. It's a completely technology neutral and agnostic regulation where we trust the innovative power of all of you to make the economic decisions. The framework is there. We initially set this rule up for DLT-based debt obligations. However, we've just added on the empowerment and use the empowerment of the law to also start a consultation process to issue DLT-based fund units. So in that sense, we are gradually expanding the scope of our legislation to let more and more assets be issued under this legislation. We're also convinced that we have set the framework to expand further in the new legislative period. Quite a lot of the parties that are up for election have said that they want to use this framework, especially, and I think that's the most important thing to be tackled in the new legislative period, is to find a framework for the issuance of equities under this framework. And we're, of course, very constructive on this. However, of course, debt instruments are much easier to set up due to the varying ability to pay dividends, to have stock splits, to have capital increases. So I think anyone can understand that equities is a more difficult security type to wrap under a legislation like that. But we're really keen to do it in the new legislative period. So please give us a little bit of time, but we're committed to make more progress. On the topic of the digital euro, which I know was also a big topic here, I completely agree with what my friend and colleague Benoit Cœuré has said at Eurofee last week. Namely, we really have to accelerate, we really have to be ambitious to make sure that Europe stays at the forefront of innovation in terms of payments. We have a very good infrastructure with SEPA, with SCT-INST, with Target, with TIPS. So the pipes, the infrastructure is there. And the opportunity to layer on CBDC on all of this infrastructure will give us added innovative power. Of course, nobody wants to force anyone to abolish cash. Cash will remain available. The experience that many jurisdictions are making is that cash by free consumer choice is being used less and less. And even we in Germany, who have been very cash heavy users of cash relative to digital payments through the Corona crisis, have made the experience, wow, digital is a way to go in terms of payments. The adoption rates, both on the merchant side and the consumer sides, have picked up massively. So I think that's a clear trend that will not be reversed post-crisis. And of course, the central bank, the ECB, can and will use this as an opportunity. We are convinced that we need involvement of the private sector. We need to foster the innovative power of the private sector in addition to the work that the ECB is doing. The incoming that we are getting from our market participants is really strong on the corporate sector. So yes, we're getting very good feedback on retail usage of CBDC, but I think one aspect that we have to take into consideration and that we have to foster is also to make sure that the ideas around tokenized commercial bank money, programmable currency are also used and embraced, because that's really where we're seeing a lot of activity of our innovative industry. So in that sense, CBDC can also lead to a competitive advantage of Europe in this space. If we then finally succeed, as my last point, in marrying all of these aspects of digitization with the concept of self-sovereign identities, which we are also massively promoting with several use cases, one of which relevant to the financial industry will be a completely digital way to open bank accounts through wallets and using the concept of self-sovereign identity within a few seconds to eliminate all of the disruption of the common video ident, paper-based identification procedures, I think will also foster a new wave of innovation. So all of these ideas, I think, show that we're very serious about innovation, and we are also committed to continuing that. There's a very big consensus in Germany. So I think irrespective of the result of the upcoming election, we will see more and more financial innovation to come in our country. Many thanks.
Thank you very much, Mr. State Secretary Cookies. I think listening to your speech and also seeing how much has happened in the last 1 or 2 years, I think it's safe to say that Germany has been at the forefront when it comes to developing new frameworks around crypto, around the use of blockchain in the capital markets. So thank you very much for your closing keynote. I would like to ask one follow-up question, if you have time for that, and pick that up from the audience.
Sure.
From your experience, also from your talks to international colleagues from other jurisdictions, for example, in the US or China, what would you say on how our European or German approach, on how that differs from, for example, the US approach or the Chinese approach towards digital currencies, both central bank digital currencies, but also crypto assets and cryptocurrencies? What is the main difference there?
Well, I think we've all seen that. Of course, China was ahead of the curve on central bank digital currencies. They've started the process earlier. So in that sense, I think it is very good that the ECB is now catching up and developing this. So in that sense, we may have a bit of a delay, but I'm optimistic that due to all of the very strong infrastructure that we have, we really have a chance to catch up. I think the other big trend is that all regions are positive on leveraging the innovative power of all of these trends. But at the same time, more and more questions, of course, are coming up on how we can set up a reliable framework that will protect market integrity, that will protect consumer interests, and that will avoid quite a lot of the mishaps that have happened in terms of fraud, in terms of issues with AML. But I think that's a very normal passageway. But if you read what SEC Chairman Gary Gensler has been saying, if you read what the EU Commission has been saying, it's going in a very similar direction, I think, of A, fostering innovation, but B, in a safe and sound way.
Yes, thank you very much for these insights. Thank you very much for your work, also for the German financial ecosystem. We appreciate your time and your work a lot. We hope, obviously, that you will stay with us for the next 4 years, also after the next election in approximately 10 days. We're running out of time, so unfortunately we have to come to an end here, but thank you very much, Mr. State Secretary Cookies.
Thank you, bye.
Yes, so as mentioned already, unfortunately, we have reached the end of our Digital Euro Summit 2021, although there would be obviously a lot left to talk about. It was a huge pleasure for me to co-host and to co-moderate today's event alongside Kevin Hacke, my colleague and friend who's coming back to the stage. I can only speak for myself, but I definitely learned a lot in those last 4 hours. So I would say let's definitely follow up on this and do it again in a couple of months or at the latest next year. What do you think, Kevin? Any final remarks?
Well, I can only agree, Patrick. I think it's been a wonderful afternoon, and thanks to everyone who bared with us the entire evening. But let me say just one thing. If you haven't had the chance to follow all sessions, no bad at all, because all sessions, the entire program, will be streamed or will be available, that's the better way to put it, on YouTube, at least in a couple of days. So no worries about that. And of course, Patrick, I think there's so much going on as of now concerning the future of money, CBDC, so definitely something to build upon in the next couple of months.
Yes, and in that sense, hopefully see you soon. Thanks to everyone for listening and have a good evening.
Bye.
Bye-bye.